Good evening, everyone. How are you? It's been coming to almost a month plus since our last webinar, and I'm glad you are able to join us tonight. And just before we start, please allow me a few minutes to introduce the club. So, firstly, my name is Richard, and I'm one of the committee member of OTCS, the organizer for this webinar. And today, if you have not already joined our Telegram channel, please search for Online Traders Club in Telegram and join the channel so that you can be kept posted of our upcoming webinars and seminars. Okay, or alternatively, if you would like to receive the notification in your email, please go to our website onlinetradersclub.org/mailing list to join our mailing list to be kept posted. Okay. Now, firstly, Online Traders Club Singapore, or OTCS for short, is a non-profit society formed in 2005, and we are a community of traders and investors here in Singapore. And to me, OTCS stands for a place where we network, share, and learn, and we do it through a series of workshops, webinars, such as the one you're attending, courses, and our library. And for workshops and webinars, we aim to have about 10 to 12 a year. Normally, it's free for our members, but the public will need to pay. But ever since the COVID situation, we have opened up our webinars for everyone to attend for free. And this is a picture from one of our workshops that we had back in January. It was conducted in the SGX, the Singapore Stocks Exchange Auditorium, and it was very well attended. And SGX was one of our sponsors back then. And ever since the COVID days situation, we have moved everything online to the webinar format, and we hope that it'll be soon that we'll be able to hold physical workshops again. Okay, once the situation has improved. For courses, we aim to have about 3 to 6 a year, and normally we will approach certain trainers who we think their courses are of good value, and then we do something like a group buy with them to give us a better value for our members to attend. And as for our library, we have about $6,000 worth of resources that our members in Singapore can borrow. And if you would like to find out what they are, you can go to our website, click on the library link, and then you can download a PDF with all the resources that we have for our members to borrow for free. So again, OTCS to me is a place where we network, share, and learn, and we do it through a series of workshops, webinars, courses, and our library. So the question next is how much? Now, normally our membership fee is 120 Singapore dollars a year, but for a time limited period only, it is only $60 a year. And normally when we have our physical workshops in person, we also provide dinner. So if you come for 10 to 12 times, basically the membership is free because all your dinner are paid for. Okay. So to find out how to join us, please go to our website, onlinetradersclub.org, to check out the membership details. But the good thing about this period is that everything is free, so there's nothing to pay and you can enjoy all the sessions that we have for you in webinar format. Okay, so again, for those who have just joined us, please join our Telegram channel, Online Traders Club. Search for it in Telegram to be kept posted of our upcoming webinars and events. And also sign up for our email mailing list on our website at onlinetradersclub.org. Now, at this point, I would also like to give a shout out and recognition to the OTCS crew, who are our good friends, who are members of our club, who help us out behind the scenes to run smooth operations during our in-person webinar seminars. So a very big thank you for you to help us out. And very importantly, our disclaimer. So We are responsible for your own profits and losses. The speaker's opinions are their own and does not represent OTCS opinions. OTCS is office holders, associates, sponsors are not responsible nor liable for your losses. And OTCS events are for educational purposes only and should not be construed as advice. So when you're in doubt, please seek professional help. Now, with that out of the way, we can go into our webinar proper, okay? So just before we do that, I'd like to share with you my point of view about our pursuit to wealth. And to me, there are two paths to wealth, and you either take the path of a driver or a path of a passenger. No, it doesn't mean one is better than the other. It's just that there are two different paths. It's just like some people they like to drive, and some people they just like to be passenger. Okay, so to be the driver, it means that it is an active trader or investor path. Which also means that you need to do it yourself. You need to learn, you need to do all the analysis, and of course, you need to click buy or sell yourself. The other path is what I call the passive path, where you're just a passenger. You basically just want to get from point A to point B, and you don't want to do a thing. So that is the DFY path, which is done for you. So between the two paths, you don't have to choose either one. Yeah, you might want to consider doing both if you want. You can be, sometimes you like to be the driver and sometimes you like to be the passenger. So for tonight's webinar, our speaker, Mr. Tam Kim Wen, will be sharing with you how you can be a DIY investor in REITs. Okay, so that's the active path. And if you have questions, and I'm sure you will have, please note it down and hold it until the end of his sharing. Then you can type in the questions somewhere on your device that you're watching. You may need to scroll up or down to see the chat box, and you can type in your questions there, and then we will have a full segment for us to consult Wien to answer the questions that you have. Okay, so keep your questions till the end. And without further ado, I would like to invite our speaker for tonight, who will share with us about the Singapore REITs, one of the hot favorites of Singaporeans, which is properties, and REITs being one of the ways to invest in properties, and how we can position ourselves to ride the COVID-19 recovery, because we are on the road. Singapore is going to open up a little bit more starting next week, and I think it's very timely that we have this webinar where our expert REITs investor can share with us how we can ride the COVID-19 recovery. So with that, I'd like to pass on the stage to Wien. Wien, are you there? I can see you.
Yes, I'm here.
Awesome.
So let me just, I hope my screen is being shared now. No, I think it's not. Oh dear. Yes, now I think we are online. Okay, thanks very much, Richard, for the wonderful introduction. I hope the camera is right now well focused on me, so you should be able to see me and my hand gestures and all that. So all right. So thanks for joining us. I see there are over 100 participants here, so thank you for really spending the next 2.5 hours with us. And I think if you stay with us all the way, I'm sure there's much to be much that you can benefit from. And today's session is entitled Positioning to Ride the Recovery. So we're going to go through a look at the various S-REIT sectors, how they've been impacted by COVID, where I think the value is right now, what you should do if you have missed the first race, the first run-up, what happens next, and what should we do? So how do you position your portfolio with a bit of heavy emphasis on the REITs aspect for the potential recovery post-COVID-19. Personally, I think 2020 is just a terrible year. So it's terrible for two reasons. One reason is the people who have made bets that gone sour. So really, really terrible year. And another are those people who did not dare to buy in the April, May, and June downturn. It was just a terrible year because it's just not that you lost money, but you just missed a big, huge opportunity. So, but the market moves in cycles, and that's the most fantastic thing, isn't that, Richard? The market just moves in cycles. There will always be an opportunity again. And how do you position for the post recovery, right, Richard?
Yes.
Very awesome. Okay, so before we start, I just want to share that everything that I share here is for the purposes of education only and does not constitute a buy or sell recommendation. I'm actually not licensed by the Monetary Authority of Singapore to provide financial advice. Therefore, everything I say or do is for educational purposes, and therefore I am not able to tell you what you can buy, what you should sell, what you can hold. However, we are happy to discuss pros, cons, where I think the value is. But if you are in doubt of the financial action that you should take, please kindly contact a certified financial advisor. Okay, with that out of the way, some of you do want to contact me, and if you want to contact me at the end of the course, or if you have something to write to me, queries, clarifications, there should be an email on your screen right now. So you can contact me at wien@probutterfly.com, or you can contact me at wien@reitscreener.com. Both emails are valid and they will get to me. Now, I also run a personal blog site called probutterfly.com, so /blog. So if you've never visited there before, do pay the blog a visit. It's about 80-90% of the content primarily about REITs, although we do post other sort of content as well. But yeah, so I'm also the co-founder, besides the main author of Pro Butterfly, also a co-founder of REITscreener.com. So stay tuned. I will share a little bit more about REIT Screener as well. If you want to follow me, you can also follow me on my handle at Ging at investingnode.seedly as well. So that's all the contact information if you actually need to contact me. I do reply my emails, so feel free. Now, just a quick background for those of you who don't know me. Actually, I never intended to be a webinar speaker, seminar speaker, talk about REITs. Actually, what happened was that many years ago, I was a real estate investor. And after being a real estate investor, I discovered someone introduced me to REITs. And that person also speaks for OTCS. And that person actually introduced me to REITs. Yeah, so I'm very thankful for it because I can apply a lot of my real estate knowledge to REITs. And then I realized that it's so easy because I can access so many real estate from all over the world, right, without traveling and without ever having to, have large capital outlay. So yeah, when I was introduced to REITs, it was very exciting, and I just continued to learn more and more. And of course, when I always started REITs with a very simplistic mindset. I took the, very easy, let's look for REITs that have a high yield, low price to book ratio, low gearing, and just invest in it. And it worked for a while, but unfortunately, I think in today's markets, this what we call the triple constraint method just no longer works very well. And then if you have been investing using this method in the last few years, you have probably found that you probably didn't do so well in the REIT market, because I think, and I'll explain to you why. So a lot of the lessons that I learned evolved, my techniques evolved. As I learned more, I incorporated more strategies. And I actually, in 2017, published a book called REITs to Riches. So this book called REITs to Riches actually became the national bestseller. And when that happened, it just blew the career and put me on a ride of this path. I never intended it to. People called me for interview on radio, and people were calling me to be conference speakers and official judges and panels. People have been calling me overseas as well to speak about REITs. So I've been speaking in other countries like Jakarta, for example. I was there last year. Of course, this year with the COVID situation, no more traveling, of course. I do speak on other platforms as well. So these are all the various channels that I've been invited to speak. Last year, I was actually the chairperson for REITs Asia Pacific 2019. So that was an interesting one. And for those of you who are familiar with REIT Symposium, so that's a retail investor event, whereas REITs Asia Pacific is more institutional as well as REIT manager event. So the people who are really working in the REIT industry, in the real estate industry, they're the ones who really get to participate. So sometimes you really hear a lot about the institutional view. You also hear a lot about the REIT manager's view, their struggles as well on how they grow the REIT. So it's a very interesting aspect, and you learn a lot more with that. So that's a little bit about me. So now a little bit more about what's going to happen today. So we're going to split this into various parts. So the first part, so this is not a beginner's topic, right? So I'm not going to be talking about what are REITs, why you should invest in REITs, you know, and basically it is so it's not ultra fundamental, but I think it really gives a landscape. So the first part, I really want to give a landscape and what's happening, what's the best performing, what's the worst performing REITs in the different countries, so that you kind of have an understanding of how REITs have been behaving around globally, especially in the major REIT markets. Like Hong Kong is one of the very major REIT markets in Asia, Singapore, of course. Australia is a big REIT market. You'll be surprised. So those of you who don't know about Australia, Australia actually are one of the, what I would say, the Angmors who actually love property. The Europeans are not so much. The Europeans tend to like to rent their property, but Australians like to buy the property. So Australians are very real estate centric. So it's actually a very big market. And of course, the largest REIT markets, the United States. The REIT concept came from the United States. So we'll be doing a survey of the landscape. Next, we'll be talking about the 3 key metrics that I use when it comes to REIT investing. And it may sound very simple to you. Say, oh, wait a minute, DPU. I know what DPU is. I know what NAV is. I know what interest cover is. But I'll show you something where if you are not accustomed or you're still using the traditional REIT method, you'll see how this way of looking at things might be actually very different. And hopefully that really benefits many of first-time or REIT investors waiting to dabble into the market. Finally, which is what you really came for, which is the meat of today's session, is really the review of all the different sectors, and I'll cover all the different sectors, how COVID has impacted them, where I think the recovery will be, why I think it will recover, why I think it's still, certain sectors are going to take much longer to recover, and then we'll uncover and really go through all that. And finally, we'll talk about how we can screen for opportunities based on what we learn, where we think the value is, and finally, how do we position our portfolio really for recovery? And then final section is really the Q&A. So as Richard said, if you ever have questions, so feel free to just tap into the box, and we'll compile those questions, and then based on popularity of similar questions, Richard will read back some of the questions, because I actually cannot see the questions. I actually I'm not able to see you typing, so yeah, I won't be able to respond. But yes, so without further ado, let's start on the general landscape of the REIT market. So where are we today? So let's start off with Hong Kong. And I think Hong Kong, just a year ago, so you can see the screenshots all taken based on 1 year kind of data. So across the last 1 year, Hong Kong has lost almost 30% of the market cap in the REIT. So all the REITs have been down, they've been hit very badly. And it's no surprise, because Hong Kong has been hit by a triple whammy. First, they've been hit during 2019 with regards to social unrest due to the extradition law. Then they've been hit by the COVID-19 crisis. And then after that, they've been hit again with very poor sentiments when China instituted the national security law in Hong Kong. And that angered a lot of people, and so with that there was a lot of social unrest, political unrest, and also health scares. So with that, I think a lot of investors were pulling money out of the stock market in Hong Kong, pulling out money from Hong Kong businesses as well, and sentiments turned a lot sour. So with that, I think there were no gainers at all. So if you had invested in any REIT in Hong Kong 1 year ago and today, you would have been loss-making in terms of capital losses. And you can see the top losers are Hui Xian REIT, Regal REIT, New Century REIT, and there's a good reason for that. I think Regal REIT, for example, has a very heavy component of hospitality. New Century REIT also has very heavy components of hospitality as well. Hui Xian REIT is quite diversified, but also has some level of components. And as a result of that, I think a lot of money that's being pulled out of Hong Kong hit a lot of the REITs. And on top of that, the REITs that have a lot of heavy components on hospitality, hotels, were hit and impacted very badly. I mean, think about it. How many of you would want to travel to Hong Kong right now? And naturally, with that said, hotel REITs like Regal REIT would be hit a lot worse than other REITs. So moving on to Malaysia, you can see Malaysia is down about 10% as well, 9.58 to be exact, over the last 1 year. You can see hospitality REIT again shows up very commonly. And then you see Capital Land, and Hectare REIT, which are retail-related REITs. So retail-related REITs have been hit also very badly due to Malaysia's what we call MCO, the Movement Control Order. So with that, people were restricted from going out. Therefore, retail suffered heavily. Hospitality obviously suffered as the country is in lockdown. People are not allowed to go in and out of the country. Foreigners are subjected to quarantine. As a result of that, hotels don't really have a lot of business. But on the flip side, even though the general market has been losing about 10%, and the worst performers are actually retail and hospitality, interestingly speaking, they are still gainers in the market. So Axis REIT is one of the biggest gainers in the Malaysian market, and that's because they have a very heavy concentration to logistics and industrial sector. And because of that, I think there's a lot of sentiments about e-commerce, and I think Axis REIT did fairly well there. Looking across to the Australian market, the Australian market's also net down about 13% over the last 1 year. And you can see right now that you see a lot of Sentier Group, Vicinity Centres, and Ardent Leisure. So again, you see the leisure team. In part, you see the Sentier Group and the Vicinity Centres, which are actually retail specific, and they are also impacted to some extent. Even though Australia is very far away, they were not spared from the COVID situation. It got a bit out of control, and then the Victoria government started to do lockdowns and all that. And that affected people's movements as well. So clearly you can see that, that there's a common theme to all the top losers. There's also a common theme to the top winners, because like Goodman Group being one of the biggest winners on the Australian stock market is very exposed to the e-commerce sector as well. So they're industrial and logistics REIT, and in fact they're the largest in the Australasia region. And yeah, they work very well with the Amazon company. So again, you can see the themes, and you can see that these themes, as I explain these things, you may not have heard of some of these REITs if you are not looking across the border or outside Singapore. If you're new to REITs, you may not have heard of it, but you can see a very common theme. And it's interesting because if you go off to the United States, you see that one of the biggest gainers is actually Equinix. And Equinix is the largest data center REIT in the world. That's it's almost a 60-70 billion US dollars. So I think just Equinix alone would chew up over 80% of the Singapore S-REIT market. So just that one REIT is just that huge. Looking across the market, you can see the United States has been very flat, just raising about 1%. And you know that the Nasdaq S&P has broken new highs after the COVID. Yet at the same time, the REIT market has remained fairly flat. But again, data center REITs did exceptionally well with about 37% benefit. But again, if you look at the top losers, you see EPR Properties, Service Properties Trust, which has a very, very big hospitality component, hotel component, and they are impacted very badly as well. Messerich Co, and you can see again, retail focus, factory outlet kind of focus REIT. People don't spend as much, or if there's lockdowns, people are not able to go to these, and these are non-essential, selling non-essential, not groceries, again, would have been impacted very badly. Simon Property Group is one of the biggest, used to be one of the largest market cap REITs, but it's fallen by over 50% again. A REIT with a very big retail focus, and they are impacted quite badly. And over to Singapore, again, you can see very common themes like, for example, Keppel DC REIT, Mapletree Industrial Trust, that have a lot of data center components in their REIT. Of course, Parkway Life REIT being evergreen in the healthcare sector. Again, you see Mapletree Logistics, Fraser Logistics. So you see, again, you see a very common theme. Again, data centers, you see common themes of logistics, always playing out, being one of the top performers. On the other hand, the big losers are always Eagle and ARA, which are also hospitality focused. And you see Fraser Hospitality again. So you can see very hospitality focused, again, where the losers are. Lippo Malls and First REIT's a bit of an exceptional case. So they are not there because they are specifically due to I think not specifically due to their nature of their properties, but rather I think impact of the sponsor. So a lot of people have fears whether the sponsor can pay their rentals to First REIT. There was a lot of fears about very dilutive rights issue on Lipo malls, and that led to a lot of sell down. So you can see that one's a more exceptional case. It's more sponsor-driven sell down. But by and large, still you see hospitality as a sector where the sell down has been most severe. Yet at the same time, you see the themes even in Malaysia, in Australia, in Hong Kong, because there's no significant logistics risk, and plus there are other third-party factors besides COVID. You see data centers being the beneficiary, and the other ones you see is actually e-commerce being the beneficiary, and logistics as well. So hopefully that gives you a rough idea of the survey, and that really, in a nutshell, is the summary of how the various markets have been behaving. Top gainers is always data centers, and then followed by the e-commerce players. The worst hit is usually hotels, hospitality, and then after that, generally retail. And in fact, if you look at it properly, most of it is non-essential retail. So this is an interesting report, and it's by KPMG, but even though it's about a year old, back in July 2019, but it shows something interesting, because it shows Singapore REITs actually have one of the highest yield with regards to REITs around the world, but yet has one of the lowest volatility. So that's a very interesting report. So just a little bit of background for Singapore REITs. And that's really just the general landscape how REITs are going. So I'm sure some of you have questions. So I'll just pause a little bit here so that you have time to type a question in there. I won't be able to take the question specifically until the end, because I actually cannot see you typing the question, but it really just gives you a breather, from listening to actually key in your questions. And yeah, let me just pause here for a moment.
Okay, let me just let the attendees know that if you would like to ask questions now, you can type it in, but Wien won't be able to answer them yet until the end. And if you'd like to find out where is the chat box that you can type in the questions, depending on the platform that you're using. If you're using a computer, you should see a chat box right at the bottom right. And then if you're using your tablet or phone, then you need probably to scroll up or down to look for the chat box to type in your questions, if any. Okay, so, and for those of you who are watching on YouTube, you can't ask your questions there, so please join us inside the webinar room to ask your questions. Okay, I'm done with the instructions.
All right, thanks so much, Richard. So I'll head back and let's start chapter 2. Key metrics when I'm investing in REIT. And this is quite important because the first part really gives you a general landscape so that you understand who are the worst performers, best performers, how the general market is doing as well. The second part is quite important because the second part really talks about what I'm looking out for. Because and I want to just break it down into simple. Of course, there's a lot of complex strategies when it comes to investing in REITs, but I think if I want to break down and keep things as simple as possible, I just want to deliver 3 key steps for you. And I think that's what I will be looking for. Later, we'll do a landscape review again on the Singapore REITs, and then how do we apply this chapter. So this is still a very important chapter. And I'll also show you why the triple constraint method is not usually a preferred method when it comes to REIT investing. So let's continue. Let's start. What are the financial tools that you will need? So this is REIT A and this is REIT B. I'm not sure if you can actually see my mouse cursor. Yeah, this is REIT A, this is REIT B. They're both industrial REITs. They're both listed in Singapore. They both have close to 75 to 80% of Singapore exposure, but they also have a slightly overseas exposure. For example, REIT A has about 25% in the US, while REIT B has about 18% in Australia. So they have overseas exposure as well as domestic exposure, both in the industrial sector. Both have reasonably long WALE at about 4.2 to 3.4. So for those of you who are newer to REITs and you don't know what WALE is, it's the weighted average lease expiry. So it means on average, based on the floor space or on average based on the income, what is the average duration in years when all the tenants will expire. So typically, if it's longer, it kind of shows you that the tenants tend to be more loyal. They're willing to sign a longer lease. If it's short, it means tenants are likely not loyal, or it's just specific to that industry as well. So very similar, about 4.2 years, 3.4 years. Gearing is also about similar, about one is roughly 38, 39%, the other one's 37-ish%, about that. But the key difference here between REIT A, so you can see a lot of parts of the REIT A and B is quite similar, but the key difference really is the DPU yield. So the yield or the dividend yield, this REITs just shy of 4%, but this REIT's almost double at about 8%. This REIT is doing at about 2 times book value in terms of its price to book ratio, and this REIT is doing about 32% discount to its book value. So if we do a quick survey, you can type in your chat box. So this is the time where you can pull out the chat box and find out which REIT would you invest in? Would you invest in REIT A or would you invest in REIT B? So maybe I'll just give you a quick 15-20 seconds. Just type in your answer there. And Richard will compile the answers and just let me know and what the general consensus of estimate percentage. How many people replied A, how many people replied B. So I'll just pause here, hit the chat button and just type in A or B.
Yes, I see people typing in A and B. So please let it place your choice, your preference. Which REIT would you invest in based on the available information on the screen? So just type in A or B.
Yeah, I guess even a webinar, I guess we should be a bit more interactive, isn't it? All right. So Richard, how are we doing with the numbers? Like,
okay,
do you have an estimate of A, estimated proportion of B?
Looking at the answers that came in, I would say a good 70% of the respondents have chosen B, and the rest
30% chose A.
Yes.
All right, that's interesting. So
a few say none, neither.
Neither. Why? Why is it because there's or that's an interesting one. I wonder those people with neither. Why is it so?
Yeah, I don't know. Maybe they can type in the reason why they choose neither. But by and large, the statistics I would say about 70% chose B, and about 20-ish% chosen A, and a small
small percentage who just want to be different from the crowd. Okay, for all those of you who didn't type A or B, congratulations, you are like the most creative people out there. So give yourself a round of applause. But anyway, jokes aside, the bigger question is, which one will I invest in? And that's what you came for, right? So which one would I invest in when I'm presented opportunities like that? And I'll tell you very honestly, if you present me this slide, my answer would be, there is not enough information for me to make a decision. And that is the truth. Because looking at any of these stats doesn't tell me anything about the quality of REIT A versus REIT B. It doesn't. I'm serious. And this is a lesson that you have to learn, because when it comes to financial advice, there will be a lot of people trying to sell your financial product. There'll be people telling you to buy certain stocks, or you might sometimes go to the bank. Have you ever tried going to the bank, withdrawing money over the counter, and the person tells you, oh, before you withdraw your money, would you like to invest in this? Oh my God, everybody's trying to sell you investment products nowadays. So, and the thing is this, it's not necessarily a bad thing. You don't want to pass on bad investment opportunities. But I think the important thing is this, are you discerning enough to ask the right questions? And if you don't get your answer, are you man enough, or in some cases, woman enough, to walk away saying, there's just not enough information, I can't make a decision on that? And I think that's a brave decision as well. Walking away from investment opportunity is also a brave decision. And it's not wrong. And let me share with you a little interesting thing. This is not really REITs related, but this is an interesting Chinese math problem. For those of you who can read Chinese, it's on the screen in the image circled in red. But for those of you who can't read, can't read Chinese, So can't read Chinese, I will actually translate that for you, and it's right here. It says here, if a ship has 26 sheep and 10 goats on board, how old is the captain? Can you imagine? This is a 5th grade primary school question from China. Some guy in a Chinese school, some teacher, decided to invent a question like that. And it stumped a lot of people. And interestingly speaking, some people were just completely stumped and they had no answer. But interestingly, the people who answered the question according to the school, 90% of them actually tried to derive the answer mathematically. So the most common answer was 26 plus 10 equals to 36, and the ship's captain's age is 36. And that's the most common answer. And the truth is this. It's a meaningless question. Any intelligent person reading the question will know that this is a completely meaningless question. And interestingly, the school got a lot of bad press because of this question. Parents were outraged, there were complaints and threatens to take the kids out of school. It's quite interesting. The school actually defended themselves, saying the question is a completely valid question. And even though even though it was a valid question, they never revealed the actual answer. So that's interesting because they refused to say what the official answer was. So I suspect there is no official answer. And I suspect, very simply, that the school was actually trying to get kids to be creative. And I think that's all. So if I was an accountant this question, I would say the same thing as I would have said in this slide. I said that given the information in the question, there is not enough information to derive the age of the captain. It's that simple. And I think that is a completely valid answer for this question. And for if you learn something, I really hope that you really take this away. And when it comes to investing, don't invest blindly. If there's not enough information, ask for the information. And a lot of times, you'll be given very irrelevant information to the decision. Ask for the relevant information so that help you make a better decision. Now, that question aside, I just wanted to share with you some of the interesting answers that that apparently the school has shared with the public, saying what are the answers that it got. The more interesting answers I thought when I was reading through the series was there was a person who actually replied, according to maritime law of China, the minimum age to qualify as a ship's captain was so and so. So clearly this kid knew something, or maybe his parents were in the shipping or maritime industry. He knew something, and he knew that he needed to actually what should I say, consider the question, the information in the question irrelevant and bring in relevant information. So I thought that was quite interesting. There was another kid who actually replied this, and I thought it was also a very creative answer. He said, if a school had 26 students and 10 teachers, how old is the principal? And he basically asked the question back at the invigilators, which is an interesting one, I think. So I thought those were more creative and interesting answers. But really, I think it's simple as that. It's just there is not enough information to derive the age of the captain. And in Warren Buffett's own words, never invest in anything you don't understand. Because if you don't understand it, get the information you need. And if you don't get the information you need, walk away from the investment, because there's just no conceivable way whether you can actually make a decision whether it's right for you. Now, coming back to this, what then? If this is not the right information, this is what I consider not enough information. What is the information I would want when deciding between REIT A and REIT B? So let's go through that. So the first thing is called the distribution per unit. Again, many of you, I think, are not first-time investors, so you probably know what this is. It's just really the total amount of dividends that's given to you for every share you own. Now, remember that this is actually a very critical component. A lot of people underestimate how important the DPU is, because the share price is always quoted per share, per unit. So when you see a share price on the stock market, that share price is for every one share. Now, here, DPU is the dividend you get for every one share you own. So what happens is REITs are generally fairly predictable. The share price over the long term, of course, in the short term, there's going to be volatility, right? But in the long term, I'm referring to about 5 years, share price will follow the trend of its distribution per unit. Now, of course, the distribution per unit is used to calculate the yield, and the yield is really how fast you can actually recoup your original investment. So a lot of people may not have understood what yield is. They assume they understand, but a lot of people don't. And that's very interesting, because a lot of people say, oh, all right, so what does this yield? Oh, it's a 5% yield versus a 10% yield. Well, which one is better? It doesn't tell you anything about quality, right? It just tells you how fast the dividend will repay your original capital. And if it's 10%, it means the dividend will repay your capital in 10 years. If it's 5%, it'll take 20 years to repay your capital. It's a speed at it that your dividend can repay your original buy price. That's a caveat though. If you watch my definition properly, it says, assuming all else remains constant. And this is the part that people always misunderstand about yield. They think that the yield tells a quality. The truth is it doesn't. And the yield actually makes a key assumption that it is constant. Everything remains constant. And the truth is, in the stock market, nothing remains constant. So in a lot of times, yield actually doesn't work very well. Now, so let's take a look at REIT A and REIT B. And REIT A, actually, you can see this is the distribution per unit trend of REIT A, and this is the distribution per unit trend of REIT B. And you can see here, REIT A has actually been growing a compounded of about 3.5% every year for the last 5 years. REIT B has been declining about 9% every year for the last 5 years, every year. So can you imagine what this means to you? So if just imagine 3% a year, 3% a year, 3% a year for the last 5 years. Here is 9% a year, 9% a year, 9% a year, 9%. For the last 5 years, each year, 9%. And watch, observe this. During this time, you can see that the DPU was climbing, so nobody can dispute, right? There's a climbing trend. And suddenly there's this big drop in the dividends per share or dividends per unit. And what happened here? COVID happened. And that's exactly what happened here. So because REIT A actually reduced its DPU payout by about 15%. It retained money during the COVID-19 due to uncertainties. The DPU actually fell. But even though after it fell, you can see that from 5 years ago, it's still net higher. Now, REIT B actually ran into a similar situation. Had REIT A not actually retained the 15%, it would actually have been higher. Now, REIT B suffered similarly because of COVID, so it did a retention of about 20%, if I'm not mistaken. So with that amount of 20% retention, that dropped the DPU. But if it had not retained it, it would still be lower than the previous year. So it will still be somewhere here, and it'll still be showing a downtrend. So maybe it wouldn't be falling at 9%, maybe it would be falling at 6%, not as severe, but still you can see the trend is still generally downwards. And this is the first key that you need to take note when you are investing in REITs. REITs need to be able to continuously grow their DPU and consistently grow its DPU. Shows a track record of continuously growing DPU, and it will likely do very well, and the share price will likely follow. Don't over focus on the yield. Focus on the DPU trend. Can it continue to grow its DPU? That's the first key that you need to know. The second part is the net asset value. So the net asset value really is very simple. It's the total assets minus the total liabilities. And to put that into a very simple layman terms, what it means is if the REIT decides to one day close down, what it'll do is it'll take everything it has in its assets, basically all its properties, it'll sell them all for cash, take the cash, pay off the debts that it owes, and what is left behind belongs to who? The answer is it belongs to the shareholders. So this is what is known as the book value or the net asset value. So it's the assets minus the liabilities gives you the net asset value, basically what shareholders now own. So it's pretty simple, total assets minus total liabilities, as I said, but what's more important is not so much the absolute value of its net asset value, it's the net asset value per unit that you want to know. So it's, again, just like DPU, it's the total dividends divided by the number of shares. NAV per unit is also the total NAV divided by the number of shares. So that's simple because, again, everything is quoted per share, and therefore, when you're looking at NAV, you also look at the per share basis or per unit basis. So with that, again, just like the yield, the net asset value is used to actually calculate the price to book ratio, and it's very commonly taught in financial literature and financial books that price to book ratio is a valuation technique where you take the price of the share divided by the net asset value per share, and you should get a ratio called a PB ratio. And the PB ratio tells you whether you're buying something overvalued or undervalued. And the traditional teaching is if it is above 1, it's overvalued. If it's below 1, it's undervalued. And this makes sense in a way, if you think about it. Let's say, for example, you pay $1. So $1, you pay $1, but you're only buying 80 cents worth of assets. So $1 divided by 80 is definitely above 1. So it sounds like you're buying something overvalued, right? Makes sense? Now, let's look at it the other way around. Let's say if you pay $1 to buy $1.20 worth of asset. So 1 divided by 1.2 would actually be below 1. So the conventional wisdom again states that you're buying $1.20 worth of asset for the price of $1. So that's actually undervalued. So it's very common in financial literature to teach. So you buy REITs when it's below 1 and then sell REITs when they are above 1. And I want to say something. If you are studying for an exam and you're trying to pass a financial exam, please go ahead and answer this textbook answer. But I can assure you that if you're using this for REITs, especially in Singapore REITs, for the last few years, I can tell you something, you probably wouldn't have fared as well. And you probably end up picking some subpar REITs. So I would say don't rely on this conventional wisdom. And there are a lot of reasons behind why you would do why this is so. Now, remember, net asset value is the total assets on the balance sheet minus the total liabilities. Now, total asset on the balance sheet, does that mean that everything about the REIT is always tangible? And the truth is, no. Even properties, there are a lot of intangible value inside properties. And some properties just trade at a higher price than another. I mean, you can have exactly 2 pieces of property built by the same developer in the same tower, exactly the mirror layout with the same furnishings and everything. It doesn't mean it'll trade at the same price, because this one could be facing the lake and this one could be facing the graveyard, and they will command completely different value. Materially, they're the same. Tangibly, they're the same. But there's a lot of intangible value inside that cannot necessarily, or intangible discount sometimes, that is placed inside that the market sees, but it's not something you can put into your balance sheet. So I'll give you a few examples. For example, what if the REIT is backed by a very strong and reputable sponsor? How do you put that and value that in your balance sheet? What about if the sponsor is also a government-linked entity? So if it's Mapletree or Sendas, which is indirectly owned by the Singapore government through its investment arms, that actually provides a certain safety and strength. And how about branding? What if this REIT has a brand that's more well-known than this REIT? So how do you put a value on brand? How do you put a value on a strong sponsor? How do you put a value on potential pipeline of properties that it can acquire? How do you put a value on that this REIT is backed by a government-linked entity? And there are a lot of these intangible factors. Another example would be markets are also forward-looking. And because markets are forward-looking, they know that an acquisition is coming. They know that they will get a good price. They know that going forward, its value is going to go up. They know that the rentals are going up. Therefore, the valuation of the property will go up. So the NAV is likely to go up. So they say, I'm willing to pay a higher price because I know next year the valuation will go up to catch up with what I'm paying right now. So markets, again, are forward-looking. So they look at all these intangible things. How then do you put a value of growth? How do you put a value on that? And you can't just put that on the balance sheet. So by taking price to book ratio above and below 1, you are making a pure assumption that everything is tangible. Value is completely tangible. And the truth is the market has a combination of both tangible and intangible value. Because if everything is tangible, some of the loss-making tech stocks should collapse by now. But the truth is a lot of loss-making tech stocks like Twitter have been around for years and they're still loss-making and they're still happily loss-making, and or Uber or some of these, or Peloton, they're still loss-making, but it doesn't mean they have no value. They have value. They have value in the database. They have value in certain intangibles. They have value in terms of the market monopoly. the advertising reach that they have. So there are a lot of other intangibles that not necessarily are in the book value, and you have to be aware of that. So the traditional thinking probably worked many, many years ago when people don't see intangible values, but today the market is actually ripe with people looking for intangible value as well. So don't assume everything is tangible. Even in REITs, even though they are heavy asset, not everything is tangible. All right, let's take a look at the second chart. REIT A actually shows a 5% per year growth compounded over the last 5 years. And REIT B shows that the net asset value is dropping about 5.6% every year for the last 5 years. So looking at this, you can see clearly that the net asset value growth of REIT A is sustained, while the net asset value growth of REIT B is negative. And REIT B shareholders are actually losing value per share every single year, roughly to the tune of 5% every year. So over the last 5 years, it's not been doing very well. So this is the second key. REITs that can continue to and continuously grow its net asset value per unit will actually likely show capital gains rather than REITs that don't. So REITs that have their DPU fluctuating and their NAV fluctuating, chances are we'll just see their stock trade in a range. REITs where their DPU and NAV is uptrend, chances are high the stock price will follow. If REITs where their DPU and NAV is downwards, chances are the stock price will trade downwards. So don't over-focus on the price to book ratio. Focus more on whether it can grow its DPU, number one. Number two, its net asset value per unit. All right, let's go on to the third one. The third one is called the interest cover. And the interest cover is a very simple concept. It's really the income divided by the expense. Now, the largest expense that a REIT usually has is actually its interest. The interest it has to pay on its loans. Now, because that's the biggest expense, if you can cover or manage the biggest expense, that means that you are likely to be well taken care of. So typically you could use the net property income over the interest expense, or you can take the EBITDA over interest expense. They're actually quite common ways. And what I've done is here, I've actually done an illustrative concept for you, where I've taken 5 portions of income, and out of that 5 portions of income, 1 portion is used to pay the interest cost. So again, this is primary school fractions, very simple to understand. If 1 part of my 5 parts is used to pay interest, I have 4 parts left. In other words, I have 80% to pay other expenses, and as well as reward shareholders with dividends. Now, let's look at the other chart. Let's say I only have 3 parts of income. 1 part of the income is used completely to pay interest. That means 1/3 of my income is actually used to pay interest, and I only have 2/3 left to pay other expenses. And this is likely to mean that I'm not able to reward my shareholders as much with dividends. And when this happens, what's going to happen? Think about it. Clearly, you can see this puts shareholders at a greater risk. So REITs, generally, I like REITs where they have interest cover of 5 and above, and REITs where they have interest cover of 3 and below, I would find them a bit of a high risk. So of course, then you ask, what about REITs with 4 interest cover? What do you do with that? I'm saying, well, depends. Are they showing very strong DPU growth? Are they showing very strong NAV growth? Are you willing to take the risk at 4? If so, all right, fine. So there are some middle grounds as well, which are not necessarily very conservative, but they're not necessarily very safe either. But if it's 5 and above, I feel that the risk is very well managed, because interest costs, just imagine, if interest rates increase, it may hurt the REIT. But if the REIT actually has a very large interest cover, there's a lot of income to buffer that increase in interest costs. And today, currently, my view is interest rates are likely to stay low for longer. So, well, that probably means in the next few years, it's a long-term benefit to REITs and real estate in general. But of course, you're going to see volatility for the rest of this year with Trump's elections coming and a lot of other things. But I think if you are willing to look at a 2-year, 3-year, 4-year post-corona recovery, I think REITs are likely to be one of the big beneficiaries with ultra-low interest rates. Tech stocks have already run up, so people need a place to actually rotate their money into as well. So again, with low interest, I think REITs are poised to benefit in the next 3 to 5 years. Now, key 3 is actually to look at the interest cover. A lot of people over-focus on the gearing, and I'll tell you why gearing is actually not always very reliable, because a lot of debts can be hidden. And one way to hide those debts are through what we call perpetual securities. And those don't show up in gearing. So even though REIT B had about 36% gearing, if you include the perpetual securities, they're actually closer to 40%. So what I prefer is to use the interest cover and how many times their income can actually pay their interest expense. And that actually gives you the liquidity risk perspective. So REIT A, you can see, is perpetually above 5. So the line here is at 6.1. And you can see that right now it's trading at about a 7.9 interest cover. So its income can cover its interest expense almost 8 times. 8 times. REIT B, on the other hand, has a declining interest cover. You can see that right now it's only at about 3.4. Not a red flag, but very close to the red flag. So it's still not below 3, but still not the most conservative. And this, of course, fortunately for REIT B right now, we have low interest rates, so they won't be hurt as badly. But if interest rates suddenly spike, it can be very dangerous for shareholders of REIT B. All right. And as a result of that, observe the trend of REIT A and observe the trend of REIT B. So you can see the 30% of you who picked REIT A, congratulations, you have done very well. So you can see with the growing DPU, growing NAV, and very conservative interest cover, REIT A actually almost more than doubled in the last 5 years, returning roughly 115%. That's just capital appreciation without the dividends. Now, on the other hand, REIT B lost about 40% of its value. So from over 80 cents to about 48 cents right now. So this chart was just snapshot about 2-3 days ago. So you can see the fourth thing that you really need to be mindful of is REITs are not dividend stocks. So the people who teach you REITs are dividend stocks really don't understand REITs. Why? Because they don't understand REITs can grow. They just think that REITs have flat prices. The prices don't go up, don't go down. They just give you a very common dividend, and you just sit there and just retire with dividends. And if you think of REITs like that, it's really, really strange, because how many of you want to invest in real estate, buy property, and not have the property price go up? Just have the property price flat, as long as you can collect rental. It doesn't make sense. Nobody invests in property like that. So why do you ever take that kind of mindset to invest in REITs? And that blows my mind that's still widely taught that REITs are dividend stocks. They're not dividend stocks. They're growth stocks. And this is not a sign of a dividend stock. This is a hallmark of a growth stock. How can a stock actually double its value over the last 5 years? And in fact, in some cases, double, triple the value, quadruple the value. They exist as well. Capital DC REIT, for example, tripled its value in the last 5 years. And that's amazing. In fact, 4 years, it didn't even take them 5 years, over $1 to over $3. So you can even triple its value. So that's a hallmark of a growth stock, not a dividend stock. So if you keep having the thinking that REITs are dividend stocks, then you keep looking for the yield, because you make the assumption that all else is equal. Stock prices are equal as well. And that's the thing. Nothing in the market is constant. So with that, don't be afraid to look out for REITs that give you capital gains as well. Don't over-focus on the yield. Don't over-focus on the dividend as well. And if focus rather on the 3 key aspects. Number 1, is it growing its DPU? Number 2, is it growing its NAV? Can it continue to sustain that growth in DPU? Can it continue to sustain that growth in NAV? And do so conservatively, with an interest cover of around 5 or higher. And I tell you, you just have to sit tight. Don't worry. This REIT was not spared in a sell-off as well during the coronavirus sell-off in March and April. So you can see it made a very steep plunge, but it recovered, broke new highs as well, and on the way up. So you can see that it is not true that REITs stock prices are flat. Again, I emphasize key number one, growing DPU. Key number two, growing NAV and the ability to continue to sustain that growth. And then thirdly, with conservative interest cover. Okay, so don't overgear and don't be too flippant with your debt. And you should get this reward. And let me reveal REIT A and REIT B. REIT A is actually Maple Tree Industry Trust, and REIT B is actually Soilville Business Trust. And now, if I present you with these three key things, I show you what is its DPU growth over the last 5 years. I show you what's the NAV growth over the last 5 years. I show you what is its interest cover right now. Show you what's its interest cost. Now, suddenly, is this the right information you're looking for? And you can see, isn't looking at this way much better than actually looking at high yield, low price to book ratio? Instead, looking at high DPU growth, high NAV growth, isn't that a much better technique of investing? And if you had invested using this method, the total returns about $1.50 to $3.20 would have probably netted you roughly 115% returns. On top of that, the total returns, which is including the dividend, so you plus about 59 cents worth of dividend that you collected over the last 5 years, gives you a total return of about 150%, which means over the last 5 years, you divide by 5 will give you roughly 30% a year. Now, 30% a year, does it sound like a dividend stock to you? No, it doesn't. That's the truth. A lot of REITs, as you can see, and I did a survey right from the beginning, you can see that good quality REITs keep growing. Even Axis REIT in Malaysia did 15% over the last year. Just capital appreciation alone without the yield. Capital DC REIT did almost 50%. And you can see other REITs in Goodman Group and even the top performing REIT in US, Equinix, have also delivered that kind of performance. They are not necessarily stagnant price REITs, you know. REITs are not stagnant price. So invest with the mindset that the REIT can continue to grow. And if the REIT continues to show negative growth, its stock price will show negative growth as well. So Soilville started 5 years ago at about 81 cents. It's now 58 cents last check. And then, of course, fortunately, for the dividends that you receive, about 28 cents in total, you would have lost net about 6% over the last 5 years. Annualize that, you would have lost about 1% per year. Nobody wants to lose money. And losing 40% of your value over the last 4 years, 5 years, and then just for your dividend to just break even is just completely meaningless. Then why invest in the first place? So I hope this really transform your mindset for many of you who are REIT investors or about to embark in investing in REITs, looking at growth opportunities, DPU growth, NAV growth, conservative interest cover. And from there, as long as they can continue to sustain this, chances are over the next 5 years, the REIT that you invest in will reward you very handsomely. So focus on capital appreciation as well as dividend, not just focus on the dividend and forget the capital appreciation. So hopefully this opened your eyes to the way I look at REITs, and don't be afraid to ask for this information. All right, so that brings us through to part 2. And part 3, I'll just talk about the sector review. So all the various sectors in Singapore, there are many sectors, the retail sector, office sector, industrial, hospitality, healthcare, data centers. How has the sector been doing? What is the impact of the COVID crisis? Where I think the value is, and I'll share that with you shortly. So starting off, the first thing, the retail REITs. Now, retail REITs really invest in shopping centers, retail malls, retail spaces, shop houses, stuff like that. And there are two distinct types of retail REITs. So first is the prime retail, one's the suburban retail, or the luxury-based retail, or the necessity-based retail. All right. So, or some people, what they call the discretionary-based retail and the non-discretionary-based retail. So there are many words for it, but essentially the discretionary retail are things that you can live without. And discretionary retail is very cyclic. So discretionary retail tends to be those with outlet malls or those with prime shopping centers along major shopping belts. So like in Singapore, that would be Orchard Road, major shopping belts. And then non-discretionary tend to be not necessarily prime. They tend to be where they're close to residential. They are surrounded by residential. It's convenient to get there, and they're usually what we call grocery anchored, or in other words, they are in the Singapore terminology, essential services, providing a lot of essential services and goods. Now, the prime retail sector, generally, who are the big purchasers? The big purchasers are business travelers and tourists, not usually the locals, because when business travelers and tourists fly overseas, they look at a large item, they decide to buy it, and they actually will go back to the airport, do a tax return, and they'll realize that it's cheaper to buy after the tax return compared to buying in their own country where they don't get tax returns, because luxury goods are taxed. So because of that, buying it tax-free as a tourist or as a business traveler actually is very beneficial, because you can buy it cheaper than your own home country. And that's why a lot of Singaporeans, when they travel to Europe, they will go to a Louis Vuitton store, buy some luxury goods and bring it back, and they realize it's a lot cheaper. Or some rich Indonesians may come to Singapore, shop at Orchard Road, realize that buying a premium product is a lot cheaper than back home, because they can then return the tax. Now, recently with COVID-19, the country has been in a lot of lockdown, and that means that there's no business travelers, there are no tourists arriving, and therefore the foot traffic in the luxury shopping malls will have naturally declined. And even if the foot traffic is returning, the problem is the locals are not the big spenders, and if they're not the big spenders, then likely it will lead to lower valuations of the properties if the businesses are not able to afford, and with that, we'll have to work with the landlord to reduce their rental because of their businesses that are not doing well. Now, on the other hand, there's also the necessity-based retail REIT. So, for example, I think the CapitaLand Mall Trust, as well as the Fraser Centrepoint Trust, to some extent, even Mapletree Commercial Trust, which owns VivoCity. You can see that VivoCity, or you can see that a lot of the malls that are in these properties are actually not so much dependent on foreign foot traffic. There are a lot of them are actually domestic foot traffic. So it's powered by domestic demand. A lot of them are also nearby high density residential. Singapore is a very high density country, so it's surrounded by high density residential, and with that, it gets a natural foot traffic. On top of that, during the circuit breaker measures, a lot of the non-essential services were shut down. So when the non-essential services were shut down, only essential services were open. And where are those essential services? Usually, majority of them are in the necessity-based, non-discretionary type of retail. So understanding that, looking at how the prime retail sector has fared, the travel sector has been completely devastated by COVID, and it definitely affected a lot of foot traffic. So on top of that, the circuit breaker measures force a lot of retail, especially if you are non-essential, to shut down. On top of that, a lot of rental rebates were given back to the tenants. So as a result, the landlord is not able to make a very good revenue. And prime retail REITs would be like Star Hill Global or SPH REIT, which owns Paragon, or Star Hill Global that owns Ngee City and Wisma Atria. Those are the REITs that I personally think is not going to recover so soon until at least the country starts to open up its borders. There are tourists and business travelers coming in. But the problem is that foot traffic is not going to be moving a lot so quickly, which means that they have to start to modify their format to attract locals. So with that, I think a lot of malls are actually trying to attract locals with local programs and all that, because they know that the travel sector is not going to recover so soon. So personally, I won't place my bets behind a prime retail, but I would place my bet as the first recovery with the suburban retail first. So the suburban retail, I think the suburban retail will likely recover a lot faster before the prime retail takes off. So this would be your, so I've named some REITs, right? I think I've named Fraser Centrepoint Trust, Mapletree Commercial. So these are REITs that I personally like. And they were badly affected by the circuit breaker measures, which means that they experienced a very major sell down. And that's good for us investors, because if we believe that and look forward to the potential opening, look, 2020 is a bad year, right? So write off 2020. 2020 is not going to be a great year. But the question is, looking forward to 2021, must these suburban retail REITs continue to open? Will they thrive? And I think early signs are showing that, the numbers are actually looking good. Take, for example, Fraser Centrepoint Trust. Foot traffic is roughly down about 40 to 50%, all right? But tenant sales are actually down about 5% only, which means that even though the foot traffic has fallen about 50%, tenant sales have only fallen 5% to pre-COVID levels. VivoCity, I think, showed similar signs. Foot traffic is down roughly 50%, but tenant sales are only down 20%. So they have actually concentrated a lot on actually domestic demand. So a lot of it was through e-commerce, delivery. So some of the restaurants, even though with social distancing, they actually allow takeaways. Some of them, they actually allow deliveries as well to homes. So they still generate sales. They still need the retail space. But yet at the same time, while there's a fall in foot traffic, they are actually still serving the necessity-based needs. On top of that, I think grocery-anchored retail is also likely to stay very resilient because people, if you order like a carton of milk, for example, that's fine, right? But dried goods, dried foods, but a lot of people, when it comes to fresh food, so things like your fresh vegetables, fresh fruits, fresh meats, they still like to pick and choose. So that's a very human behavior because you want to pick what you like with regards to fresh fish, fresh fruits, fresh vegetables. And with that, I think traditional retail still plays a very, very big role in groceries. And I think it's very hard for brick and mortar retail to actually, to die in that sense. E-commerce is not as easy to penetrate this market. And Amazon and even Alibaba has tried for years, and they have given up trying to fight the trend. So Amazon has actually purchased Whole Foods. And why do you think they went into brick and mortar? Because Whole Foods actually are the fresh food groceries. Why do you think Alibaba set up Hema stores? Where you could use, where you can shop, pay, scan with your Alipay, check out, and then after that it gets delivered to you. Because people still want to be able to choose. So I think e-commerce is not going to kill some retail. So I don't believe it's the end of retail. But I think retail REITs, where they have a very strong essential services. So essential services, for example, clinics, you need to see a doctor. For example, trying to call a doctor to your home is very expensive. So most people will actually travel to a clinic. Beauticians, where you need specialized equipment. You can't bring all these specialized equipment to the house. Eyewear is essential services. You still need it. You still need specialized equipment to test your eyes. You need the special machines to cut your lenses. You still need a space for that. Services, a lot of services cannot, because they are service-based, you can't be replaced over the internet. Hair salons, all that, you still need that. There's special perming machines for ladies, or rebonding machines, or for men, they may have certain equipment as well, or dyes, which you can't easily do at home. So there will be a need still for essential services and essential goods. So I don't believe e-commerce will completely kill retail. So anyone who has that mindset, I think maybe a bit extreme in terms of the view. But here, I think showing all the early signs in the market and the data points that we have, I think 2020 is a terrible year, but I look forward to 2021, 2022, where I think suburban retail will likely, recover. So if I were to position my portfolio, I would want to position it in the suburban retail right now. So we can see that everyone's now trying to switch to domestic market because they know the border is going to be closed for much, much longer. But it's not as easy for prime REITs to do that shift compared to suburban retail. So I think this is really where the value is right now. They've been whacked badly, but yet at the same time, they've not recovered the pre-COVID highs yet. So there's still value to be found. Next, moving forward to offices. So office REITs invest in office spaces, and office spaces are cyclic. Of course, the tenure tends to be longer than retail, but they're less capital intensive because you want to maximize your lettable floor spaces. Yet at the same time, you want to keep the shared spaces as close as possible, as small as possible, so you have less maintenance. Retail, on the other hand, you have very, very large public floor spaces because you need to generate foot traffic. Whereas offices don't try to generate foot traffic. Their valuation is based on tenant demand for their spaces. And a lot of talk has been about the work from home situation. So COVID has been hitting office REITs very badly. So that's another area that I think is likely overdone right now. So commercial REITs, office REITs, they have been sold out very badly because of the circuit breaker measures. Singapore government has been encouraging people to work from home. In the US, it's the same thing. And with that, I think a lot of people say, oh, I think that's it, man. Offices are dead. No one's going to use offices. Everyone's going to work from home. And I think, again, it's like saying e-commerce is going to kill traditional retail. We'll never have shopping mall. Nobody ever want to go to shopping mall ever again. Is, I think, a very extreme view, because shopping malls play a big role, especially even in a high-density country like Hong Kong or Singapore, where people's houses are small and you want to meet people and large groups of people outside. And it's not easy to host them in your house. They play a social role when you want to eat in a restaurant. Just like offices, they play a role as well. And the traditional office, if you are just there doing number crunching, data entries, support roles, well, fine, you can work from home. But there are certain sectors, for example, the sales sector, where you need to have client facing, or you need to entertain client, with a presentation, show them your nice office, show them the great view, bring them down for lunch, try to close a sale. Client facing things do need an office. R&D does need, because as a very collaborative, people need to do research, they need to investigate, discuss, look at the results, discuss again, problem solve, think of creative solutions again. Collaborative work, for example, things that are creative industries, advertising industries. Trying to work from home alone is, doesn't move the mind. You need to actually go out there, you need to smoke, you need to hang out with some colleagues, you need to brainstorm, you need to chart things on a board, you need to scribble, throw new ideas. Collaborative work requires that kind of collaborative culture, that requires a space to do so. And finally, high confidentiality work. So certain banks or certain financial industries, IT industries, there are certain parts of the work are so confidential that you're not allowed to take the laptop home, you're not allowed to bring it home, you have to work with a office-based laptop, or you have to file certain documents within the office. They have to be there's a lot more paper trails that you need to file, documentations, because you need to adhere to certain compliance, legal requirements. So because of that, there will still be need for office. So again, I think it's very extreme to say offices are all dead. And I think offices also play a very big role in the corporate culture, because when it comes to the offices, if how you lay out your office tells a lot about what the company culture is like. And how often as employees, when you go for a job interview and you see the office, you see the room you've been interviewed in, you look at that thing, and you make a decision partly also based on what you see. So the offices also play a role in actually locking in talent, getting talent as well. So you'd be surprised at how much a silent communicator the office is with regards to corporate culture and also the talent acquisition. Now, on top of that, I just want to tell you something. Office spaces will simultaneously adjust to the demand and supply. And suddenly with this shock, this shock of work from home, where practically everybody's working from home, the truth is a lot of sectors are not going to be able to work from home very effectively. There are also two types of people. There are also what we call the introverts and the extroverts. The extroverts cannot work from home. The introverts are happy to work from home. So you must understand that people are different. And because of all this, I think demand supply factors will actually balance out. So some people are going to realize that, wait a minute, why does everyone need to come to office? Let me do a strategic review. Who does not need to come to office? Let me terminate those floor spaces, put those employees permanently work from home. So this will actually increase supply of office spaces. Next up, they will start to convert some of these spaces into collaborative spaces. But at the same time, with the removal of these increase in this supply, there comes demand. There's a lot of news of bike dance now aggressively hiring, expanding. They're signing new leases in Marina Square, Marina One. Tencent wants to increase their regional presence in Southeast Asia and using Singapore as an anchor. A lot of Chinese tech companies are doing so. So that will increase the demand. So while there's increase in supply, it will likely balance out by increased demand. On top of that, with all the circuit breakers measures in place, with all the social distancing measures in place, all the sanitation measures in place, I believe that actually the per employee space, space that you need per employee is likely to be increased. So cubicles cannot be as close as they used to be. Meeting rooms need to be bigger in order to accommodate the same number of people because you need to sit on alternate chairs. And then you're going to have one way in, one way out. So you can't just have the same walkway now. So you need two different walkways now for one way in, one way out, so that everything's unidirectional. You need a place, to make sure things are more sanitized. So that will actually increase the demand per employee. So even though the work from home will actually reduce demand, it will be compensated by other factors that increase demand. And a lot of surveys have shown that people don't feel comfortable going back to work unless certain things are addressed. And one of the key things is increased social distancing. There's going to be more natural barriers, so you're going to need space to put plants, for example, natural barriers in order to create that space. On top of that, banks are also going to be restricted from lending as well. So because of the uncertainty nature, banks are restricted from lending. Because of the uncertainty in demand for real estate in the office sector, developers are also reluctant to build, or developers also cannot get loans from the banks to support their project, or because they're just not sure what the demand is, they don't dare to build. What if they build and there's no demand for the office spaces? Then what will happen? Now, the problem with that is that creates a short-term shock, again, compensating all the short-term shock from the work from home. And when developers don't build, what happens is then demand and supply factors played out. And by the time they start building, you must remember, it takes 2, 3 years, 4 years to get an office building up. And if they lose that opportunity, it creates that constraint. We have seen that situation in the HDB market before in Singapore. And when you create a constraint, the demand keeps on slowly build as the economy recovers, but yet the supply doesn't match. What happens is then it will boost the offices. So I think over the medium term, in the short term, I think offices are likely to suffer. But in the medium term, I think offices will actually experience this situation. So if you're contrarian, this could be an interesting play as well. And I think look out for offices where they have much longer WALE. So offices in the US-based markets such as Capital Pacific Oak, Manulife US REIT, Prime REIT, we're going to look at their weighted average lease expiry. They tend to be a lot longer, which means that, and US, they don't practice what we call break clauses. So because of that, these REITs tend to be a lot more stable, more predictable, since they have a much longer WALE, their stability and occupancy is a lot more stable, and they already have a work from home culture, unlike Singapore, where the work from home culture is actually very negligible. In the US, almost 40% of the workforce have certain level of work from home benefits, so they can choose when they want to come to work, when they want to work from home. In Singapore, that benefits only, so 40% versus about 9% in Singapore of workforce have that benefit. And this is from the Ministry of Manpower Conditions of Employment Survey. So we know that as well, which means that suddenly this shock will actually create a situation in Singapore where in the short term, you are likely to see reduced demand. But Singapore offices also roughly about 3 to 5 years, so which means that the weighted average lease expiry is somewhere about 2+ years, which means that those that are coming due are likely to review their office spaces and actually reduce their supply, because cost control measures during a recession is important. So you might see actually the impact hitting the shorter WALE office REITs more than the longer WALE office REITs. So a good example would be Prosperity REIT or Sunlight REIT in Hong Kong, or maybe even CapitaLand Commercial REIT in Singapore, where their WALE is a lot shorter. So look out for those with longer WALE, more stable occupancy. Work from home culture is already embedded into the culture. And also don't forget, in the short term, it may be hit, but they will likely recover. So if you ask me to play, I think suburban retail is likely to be the first one to recover, because everyone needs they are selling essential goods. Then I think in the more medium term, office REITs are likely to take a hit in the short term, and then after that, we are already seeing that hit today in office, and then actually poised to recover after the suburban retail. So I would bet on the longer term whale REITs first, and then after that bet on those. So you can see how I'm structuring and layering the recovery and positioning my portfolio as we go along. I don't think prime retail will recover as quickly, so that one will come in later. So going forward, if you want to hear even more about what I think about offices, join me next week's Wednesday, 7 p.m. to 9:30 p.m. It's completely free. And I even have Jill Smith, CEO of Manulife US REIT, join me as well. So she'll be sharing her views on the future of offices, and I'll be sharing my views on the future of offices. So it's a fantastic one. We're just going to talk about offices, yeah, just the link is below, www.reitscreen.com/future of offices. So you can take a screenshot, make sure you can sign up. It's completely for free. And it's a partnership together with Manulife as part of their Green Dot Investor Education series. So we're proud to be one of their partners in their outreach and education efforts. So hopefully that gives you a bit of flavor about the offices as well, because you can see how COVID has impacted offices in the short term, but how I see the landscape changing in the medium term and the long term for offices. Next, industrial REITs. Now, industrial REITs invest in warehouses, factories, cold storage sites, industrial parks, stuff like that. So industrial REITs are just like office REITs. They're very cyclic in nature. When the economy is great, of course, it will rally. If the economy is bad, of course, people will remove their floor space. But even industrial REITs, there are really primarily two types. One is what we call the general purpose industrial. One is called the special purpose industrial. So the general purpose industrial REITs just generally, they invest in things where their general purpose. Whilst the special purpose REITs, they build to suit. So for example, I'll give you an example, like, for example, airline industry, if you were to want to do, if you're Rolls-Royce and you manufacture aircraft engines, you will need specialized buildings where it's pillarless, because you can't have a pillar with the aircraft in there, right? In the hangar. If you're in semiconductor industry, you need a specialized building just simply to make sure that the ventilation inside, is filters out how many the dust, per million, how many particles of dust there is in the air. You have to filter those out. So it's a very, very specialized building. If you are in food and beverage industry and you have central kitchens, again, centralized kitchens require certain air circulation, waste disposals, and pest controls, and what we call biohazard waste as well. So it's pretty specialized. Another ones are logistics sectors. Logistics sectors, you need special purpose ramp-up warehouses. The building has to fit certain ways where the robots can actually move and sort parcels. The distribution trucks can actually load and unload very easily. You have ramp-up warehouses where the structural integrity, even though they are multi-level warehouses, can actually take a certain minimum load bearing on it. So they have to be specially reinforced, stuff like that. So to be able to take multi-tonnage trucks that roll in and out. So they are very specialized buildings as well. So personally, in my view, COVID-19 would probably not have changed anything with the specialized industrial REITs. But the general purpose REITs are likely to suffer because tenants are not as sticky, and therefore general purpose review really is a demand supply situation. And today, I think in Singapore, I feel that the general purpose industrial, such as general purpose factories, general purpose warehouses, tend to be oversupply situation. And if businesses and demand for goods reduce, the demand to manufacture and the demand to actually store goods is likely to actually reduce. So I think general purpose industrials, to me, is not a very fantastic play. So I wouldn't play that right now. So this would be your Sabana REIT, Soybean REIT, your to some extent AIMS AMP and ESR REIT, which have a lot heavy general purpose industrials inside their portfolio. The specialty industrials are the e-commerce players like Fraser Logistics and Industrial. But unfortunately, because Fraser Logistics Industrial is now merged with Fraser Commercial, so it's a bit tricky because then you are playing both commercial as well as the industrial sector. So just take note of that. On top of that, there will be the Maple Tree Logistics sector, where I think they really have very specialized buildings. For example, Maple Tree Logistics actually owns the island where you can store oil in it. You can't store oil anywhere else, and right now, oil is oversupply in terms of oil, so people need oil storage units. So these are all special purpose buildings. So I think industrial REITs would have probably very neutral impact from where they're specialized industrial, especially e-commerce. They will have a big beneficiary because the demand for e-commerce space is so important. And not only the demand for e-commerce space for delivery, but you must remember, people tend to return more goods when they buy online. So when they return goods, the return leg also needs to be catered for into the infrastructure when you do e-commerce. So e-commerce is not a one-way distribution. It's a two-way distribution. It's much, much more complex, which makes the building a lot more sticky in terms of the tenant. So logistics sector will be a big beneficiary, but a lot of the other specialized industrial players are likely to be fairly neutral. The impact from COVID would have absolutely not impacted them too badly. So hopefully that gives you a flavor of how I think. And I think specialty industrials where the interesting plays in. So those would be Sendas REIT, Maple Tree Industrial Trust, Maple Tree Logistics Trust, those sort of REITs. Now, going forward, hospitality REITs invest in resorts, hotels, theme parks, and all that. And they're again very cyclic in nature because, well, they are very economic dependent, because if the economy is doing well, you are likely going to see demand for hotels because there are more business travelers, more tourists. Likewise, if the economy is not doing well, you're likely to see a decline in business travelers, decline in tourists. And on top of that, they are very vulnerable to shocks. So because they're very, very short term, they could be exposed to things that are completely unpredictable. Arguably, you could predict the economy somewhat, but arguably, how do you predict terrorist attacks? If suddenly a bomb goes off in Bangkok, I can rest assured you're going to get a lot of trip cancellations to Bangkok. What about natural disasters? When Hurricane Katrina hit the US, how many people will actually travel there? Or Philippines, hurricane sometimes hits Philippines. What happens then? Or Taiwan, for example, sometimes they have typhoons. How about accidents in Japan? There was an undersea earthquake near Fukushima. It affected the nuclear power plant. The nuclear power plant, had nuclear waste spilled out, and with that, a lot of tourists canceled their trip to Japan for fear of radiation. Of course, Singapore suffered badly during the SARS outbreak, and right now we are in the midst of the COVID-19 situation. So clearly, you can see that these are things that you cannot actually predict. So when it comes to hospitality, it's very unpredictable, and there are too many variable factors, and it's very, very hard to know that suddenly one step of a finger, a terrorist attack happens, one step of a finger, epidemic outbreak happens, a step of a finger, a major accident like Lebanon, the storage facility that was storing the fertilizers just blew up. And accidents happen. You can't predict any of these. And suddenly tourism to Lebanon confirmed will be affected. So I think COVID-19 hit the hospitality sector the most, and likely borders are not going to open in a big way anytime this year. So I think air travel is going to be suffering for many years. So I think SIA is one of those casualties from COVID. I think they will suffer for multi-years before they even reach pre-COVID revenue levels. So I think it's going to be a very tough year for airlines. To some extent, hotels are going to have a very, very tough year as well. Marriott was one of the largest recipients of the government loans that the US printed. So the US, remember, had the $3 trillion rescue package. Marriott was one of the largest receivers of that loan because they are actually one of the very vulnerable businesses as well, hospitality. So I think it will be the most pronounced, especially in countries where there is a small domestic market, like Hong Kong, Singapore, out in Taiwan. They have a very small domestic market because because locals don't demand that kind of hotel rooms. Mostly it's driven because of foreigner requests, business travelers, tourists. And Hong Kong being a very small country, the domestic demand for local hotels is very small. So is Singapore. And when tourists not going into Hong Kong, business travelers not traveling to Hong Kong due to the situation or not coming to Singapore, it's going to hit the hospitality industry very badly. To some extent, it will also hit hospitality industry in large countries such as the US, but I think they are likely to recover first rather than the small countries. So if you want to bet on recovery, I would place my bets first on the larger domestic market, because in the US, people travel interstate as well. So they don't just necessarily travel by air. Sometimes they drive interstate and they still need hotels as well. So there's, to some extent, a domestic demand. Something, even though their borders may be closed, there's still domestic demand for hotels interstate, but there is no such thing in Singapore. The demand for staycation is minuscule compared to the number of hotel rooms we have. So it's really not driven by domestic demand. That's where I think hotels tend to suffer a lot more. So my bets are not really on hospitality at this stage, but if you want to take a contrarian view, that's fine too. But I would urge you to consider looking at those with a much larger domestic market, rather than those with very, very narrow focus. So Europe's another interesting one because of a lot of easy border crossings across the European Union. But I think border controls are actually in place now due to COVID and all that. So it could be a very tricky situation. And even though there's summer, some people say there's a lot more tourists, but some people say that tourists are declining. So we're not very sure what's happening unless you're actually on the ground to find out or look at data. So just be careful of that. So I think hospitality sector is probably the worst hit and likely to remain low for quite a while. But yet at the same time, is a value play if you are looking for contrarian view, but prepare to wait multi-year. So unlike for example, I was saying like suburban retail will recover. So I say write off 2020, but look forward in 2021. But I think hospitality 2021, 2022 may still not have recovered to post-COVID, pre-COVID highs. So much longer term, I think. Healthcare REITs, I think healthcare REITs are completely evergreen because healthcare REITs invest in hospitals, which are really, really specialized buildings. So hospitals, well, first of all, you need government approval to build hospitals on the plot of land. On top of that, hospitals are very specialized building. Even the lifts are longer. Lifts are meant for people lying down, not for people standing up. Right? They have to ship people lying down. Operating theaters, need to have a very, very double doors and filtration systems, biohazard waste disposal. Then you have X-ray rooms, MRI rooms, all that. And all those are highly specialized buildings because, your walls have to be thicker to prevent radiation leakage. ICU rooms need to be, filtered for minimal amount of microbes, to ensure that a critical ill patient doesn't get infected. So it's just highly specialized building. I think it's evergreen, COVID without COVID. I think it's just an evergreen sort of play. And I think with COVID, I think Parkway Life REIT has rallied a lot. And I think Parkway Life REIT personally, it's not a REIT I would chase at this point of time. Doesn't give me very good value at this current price at the moment. So I would definitely want to reposition my portfolio. So I would want to take profits from Parkway Life REIT. I won't sell everything or sell half, and then reposition them into where the next growth opportunity is. So this is how you can see I'm rotating my portfolio. I'm repositioning my portfolio to capture growth. Again, I'm writing off 2020 as a bad year. I'm looking forward to 2021, 2022, and I will want to bet first, on the suburban retail. I will take my profits from the healthcare. I want to take my profits from data centers now, sell half of them, position them into suburban retail, go into, then next go into the certain offices that are more resilient, like Maple Tree Commercial. Then after that, get into the other longer WALE offices. Then after that, play the maybe then later on a year or two, then play the prime retail, and then only head on to hospitality, which is the last on the track record. Data centers is another very popular REIT class, and it's been rallying. So you can see Equinix has been doing very well in the US. Data center REIT has been doing very well in Singapore, and mainly because I think there's a shift in terms of the way people work from home right now. They require a lot more data centers. On top of that, shift in the way people's behavior in terms of entertainment. So there's a lot more what we call home-based entertainment, video streaming entertainment like your YouTube, Netflix, Spotify, stuff like that. All these require data centers. So data centers have been big beneficiary of COVID. It's one of the best performing sectors with regards to the entire S-REIT space. And if you own it, I think congratulations, you probably made a ton of money during COVID. But if you are completely new to REITs, you don't own Keppel data center REITs, for example, probably, I don't know, $3, $3.10, $3.20. I'm not sure if you want to chase it at this price. Maybe if it comes down a little bit, you could consider making some entry. I mean, I'm a beneficiary of Keppel DC, so I'm happy that it's made money. So again, just like partway, the question is, should I start rotating part of my portfolio and position them into the next potential growth? So that's, I think, what I'm looking at. And I think data centers is evergreen again, just like hospitality. I think it's on a super cycle trend. I think it will continue to stay. I think with the 5G trend as well, more data centers are likely going to be needed. And all these shifts in behaviors, I think, will be quite permanent and here to stay. I mean, there will be increased number of freelancers. There will be an increased work from home adoption. I'm sure there will be increased tech adoption by businesses and increased home streaming entertainment. So I think it's on a multi-year super cycle. So if you're already holding it, congratulations. But perhaps now the price, you might want to let it retrace a little bit before entering and then riding that super cycle trend. So yeah, that's my view on all the sectors. Hopefully I've covered a lot of detail on all the various sectors of COVID-19, and I just wanted to share a little bit more about how I would look for opportunities. So REIT Screener is my best friend. I'm the co-founder of REIT Screener, and I think let's focus on the Singapore market, and we can see how we can screen for opportunities in the REIT space right now. So if you have heard what I've shared, so I'm probably not a big fan of hospitality at this moment. So I'll actually filter out hospitality, and you can see that after I filter out the hospitality REITs, from 40 over REITs, it's down to about 35 REITs. So 35 REITs is something for me to consider. And if you listen to me, I said there are 3 key things I want to look for REITs: growing DPU, growing NAV, conservative interest cover. So I'm going to do that right now, and I'm going to filter for growing DPU. So once I filter growing DPU, I don't want negative DPUs. I don't want negative DPUs. I want growing DPUs. You can see I suddenly brought down 35 REITs all the way down to 8 REITs. Then again, if I want to filter by growing NAV, I'll just activate the NAV filter, and you can see right now I'm down to 7 REITs. And if you want to know what the 7 REITs are, these are the 7 REITs that have been growing their NAV and growing their DPU over the last 7 years sustainably. And of course, not forgetting, you want to be conservative as well. So interest cover is something very important. Again, if you remove those that are below 4, you can see right now we are at 6. So if I reload the table, you'll see First REIT has disappeared. So I don't want to take the risk when interest cover is low. So you can see right now I filtered probably the top 6 REITs in Singapore, which I think has done well and will continue to do well, I believe. These are REITs I think will continue to do well. But the problem is not all these REITs are going to be worth buying right now. So now you can see how I filtered the REITs. Then I can only look at, say, price to book ratio. Now, the thing about REIT Screener is we do not use price to book ratio above and below 1. Unlike traditional screeners, you have to adjust a number in the price to book ratio. Notice we don't do that because we know that every single REIT is different. So this REIT, just because it's price to book ratio 1.1 doesn't mean it's overvalued. It could be undervalued because normally it trades at 1.3. And this REIT, we know that normally it trades at 0.8. So at 0.9, we know it's not undervalued, it's actually overpriced. So we know that. And that's why REIT Screener does not use the traditional screening methods. And you see, we pre-interpret the numbers for you because a lot of people don't understand how to use interest cover, for example. Is 7 a safe number? Is 6 a safe number? Is 3 a safe number? Is 4 a safe number? Let REIT Screener do that interpretation for you. And you can see we will filter out the overpriced REITs. So, with the overpriced REITs hanging around 6 right now, if you filter the overpriced REIT, there are actually only 3 REITs. And Ascendas REIT, Mapletree Industrial, and Fraser Centrepoint Trust. I think these are the interesting REITs that you could look at because valuations are not rich now. But if you get the overpriced REITs, for example, Mapletree Industrial, Logistics, Parkway Life REIT, I wouldn't chase them at this current price. So you can see, even though Fraser Centrepoint Trust, Mapletree Industrial is 1.12, 1.14, Ascendas REIT is 1.46 price to book, we don't consider that overpriced because REIT screeners algorithms are, actually rate it according to how its historical trading trends. And I'll show you that in a while. So you can see Ascendas REIT, you can see Mapletree Commercial Trust, you can see Fraser Centrepoint Trust. So let's do our quick 3 tests that we learned today. The test number 1, dividend. Does it show a rising dividend? Answer is yes, it shows a rising dividend trend. But again, due to COVID-19, it has retained a lot of its dividends. So this is a one-off situation. Very poor indeed, but again, I've written off 2020. I'm looking forward to 2021 as COVID-19 recovers. As I said, their foot traffic has fallen 50% from pre-COVID levels, but their tenant sales has only fallen about 5%. So you can see that actually it's fairly resilient, and the tenants are still be able to pay rental going forward if they are continuing to be able to generate business. So that passed our first test. And how about net asset value? Net asset value took a little bit of dip during COVID-19, but still general trend upwards, passes the second test. Third test, you can see, 6.4 interest cover, that's perfect. So you can see it stayed above 5. So this is the 5 line over here. So it was below 5 for a while, but still at 4.5, not too bad. Still growing DPU, growing NAV, and you can see in the last 7 years it's been growing. Net asset value has been growing. So I think this is a REIT that I would want to bet on. If we had done this just 1 or 2 weeks before, it would have been an excellent buy opportunity. But too bad this was today. The price ran up very quickly after the announcement of the acquisitions, but it doesn't mean you're too late, because you can see the share price is actually taking a bit of a hit right now, in line with the US. So I think the stock markets globally are weakening a little bit ahead of the US election. So that gives you opportunity to get into some of the REITs. And this is one of the signature products, a REIT screener. We have the price to book ratio historical chart. So you can see this is for Fraser Centrepoint Trust. And you can see that this represents the buy zones. This represents the sell zones. So the orange line represents the orange zone. So you can see on average, this orange line trades at about 1.1. So it's about 10% above book value. And what we do is we use standard deviations. So we have statistically significant because we have over 1,000 points. So we can do a statistically significant standard deviation. So we can calculate the first standard deviation, second standard deviation, first standard deviation, second standard deviation. And you know that within the first plus minus 1 standard deviation in your normal distribution curve, we are looking at about 68% of the trading range. So therefore, if it trades out of this range, you know that's overvalued and undervalued. And this is how I entered. So when I entered Fraser Centrepoint Trust, I entered during these seasons. And when I sold, I actually sold here. I sold quite early. So I didn't sell at the high here in March, okay, or February. I actually sold here because it broke the high here. So I was waiting for opportunity to buy, but it didn't go below this orange line. It recovered very quickly. So I was actually, after selling half, I was very disappointed that I didn't catch the high. But still, as you can see, COVID-19 gave me the opportunity, and I got in here at a very, very good price. And I was riding this again, so I'm very, very happy. Right now, I'm looking for it to dip, hopefully dips below the orange line. I'll add more positions to it. So this is one of our signature products for our REIT screener. So you can click on price to book ratio for Mapletree Commercial. You can see again, not super, it's below the orange line, so it's trading below its usual average. Again, this was entry, this was exit. I sold again, you can see, I sold when it broke the high somewhere here in October. And then I was very disappointed because for almost 6 months, I was like, oh my gosh, I sold too early. How come I didn't sell later? How do I know the market will rally for that much longer? It was really irrational. And suddenly, COVID came and I managed to get it below the 2 standard deviations. So I bought it undervalued again, and now I'm quite happy riding the next wave. So I think these are REITs that I think are poised to recover. Ascendas REIT is another interesting situation as well. Right now you can see it broke here. I regret not buying a lot of Ascendas, because Ascendas, I was waiting and hoping it will break 2 standard. It didn't, but still, retrospectively, this was a good buy. Even it was so close. Why not? I was hoping it would do something like this, break, but it didn't. But so I didn't buy it big in any way. But I did sell here. When it broke somewhere here. Where did it break? It broke somewhere here, I think. So that's where I sold as well. So this ride a very good recovery. I'm waiting for it to fall back into the orange zone. So hopefully I could get it at a moderate range. It's slightly on the expensive side now, but hopefully it will come back down a little bit, moderate a little bit. So I think these are where I think the value opportunities are. So you can see COVID-19 has given opportunities to some, and you'll be wondering how come this method didn't manage to pick Capital DC REIT. And if you have noticed that, and that's a really great question, and the truth is because Capital DC REIT is a 4-year-old REIT. So actually it won't show up in your 7-year chart because it doesn't have a 7-year history. It will show up only in your 3-year chart. So you can see if I were to look for Capital DC REIT on the 3-year chart, there are 5 REITs, and you will see Capital DC REIT right here. Mapletree Logistics, one of the best performers as well. Mapletree Industrial, Parkway Life REIT. So you can see Capital DC REIT does show up in the searches. So usually I will look at short-term high growth REITs, medium-term high growth REITs, which is 5 years, and then the long-term high growth REITs, which is the 7 years. So you can see the 7-year ones really are showing some value. So Ascendas is showing some value, not as good value as Mapletree Commercial and Fraser Centrepoint Trust. So Ascendas REIT plays more towards the specialty industrials. Mapletree Commercial is where I think I'm riding the recovery in offices, especially these are non-CBD offices. These are where there's a lot of tight supply in the Harbourfront, Alexandria region. On top of that, there's Vivo City as well. So I think Vivo City is not powered by, even though it's not exactly a neighborhood mall, but it's powered by domestic traffic, and I'm riding that recovery because it's domestic driven. Fraser Centrepoint Trust is definitely domestic driven, and I'm riding the recovery. So I'm playing these recoveries, and I'm positioning my portfolios with this. So I hope you got a lot of interesting insights, and I just wanted to show you something interesting again. And a lot of people, when they first get a screener, what they'll always do is they will say, let's take the high dividend, low price to book ratio. And what they'll end up doing is selecting high dividend, low price to book ratio. And this is what they will usually end up with. And, and forgetting to look at the sectors. What they'll end up with is, ARA Hospitality, Fraser Hospital, iREIT Global, First REIT, Star Hill Global, Lipo Malls. Not very great performers, as you can see. And if you had filtered based on these performers, what's going to happen is, you end up with getting these kind of REITs. And you can see right now, these REITs didn't perform very well. And 6 out of 6 actually really failed to perform. So a much better way really is searching for consistently growing DPU, consistently growing NAV, consistently safe interest cover, preferably above 5. And then identifying which sectors you don't want to. So with the help of what I've shared about pre-COVID, COVID impact, and what I see post-COVID, I think hopefully you can use the sector to your advantage. And I think you will actually find out and discover really great REITs in Singapore. And if you were investing in one of these 6 REITs, or if your portfolio had these 6 REITs, you have done much, much better than previously using the other triple constraint of high yield, low price to book ratio. Of course, if you use the 3 years, you will actually also discover there's Capital DC REIT, and Capital DC REIT, tripled in value over the last 4 years. So it's one of the highest growing REITs in Singapore, and in fact, it's one of the highest growing REITs in the world as well. So if you screen REIT screener across the world, Capital DC REIT actually does come up as one of the high performing REITs as well. So the REIT screener is free to sign up. Of course, if you are using the free service, you only get the Singapore data. But of course, if you're using a paid service, you get service across all the regions that we have right now. So if you look at this method, across the regions, you're looking at moderate growth, maybe moderate growth REITs with moderate safety. That's 16 REITs just for you to look at to potentially invest. And then if you use price to book ratio, and you're looking for those that are reasonably priced or even those with good value, that's easily 4 REITs that you could invest in. So look at the Kilroy, Champion REIT, Douglas Emmett, Link REIT in Hong Kong, 2 in Hong Kong as well. Hong Kong, I think, has been beaten down very severely because it's been hit by the triple whammy, remember? So I think Hong Kong presents some very good opportunity and value. You can see across the world, if you are willing to pay at a reasonable price, there's actually a lot of REITs to invest in, and they are very high growth REITs. And just looking at some good value REITs, for example, Link REIT in Hong Kong. Look at this. This one's interesting, right? Look at the dividend amount. Isn't this a beautiful dividend? First, check. Second, check. Of course, it's down because its valuation has been hit by COVID. So, yep. Look at the interest cover, 7.8. Again, passes my test. So you can see it's consistently above 5. But at the same time, you can look at the price to book ratio here. Right now, you can see it's actually in the green zone. So it's actually giving you very good value. So I think Link REIT's actually one of those poised to recover, barring any unforeseen circumstances or bad news in Hong Kong again. So again, looking through the crisis, really, I'm looking at repositioning my portfolio, taking my profits from some of my very high growth REITs that have done very, very well, taking some profits out there, and reposition my portfolio for these potential growth opportunities that I see come in 2021, 2022. So yeah, with that, I hope you have benefited a lot. For those of you who are interested to find out more about REIT Screener is free for the Singapore data markets. Of course, there's a lot less screening strategies. Some functions are not available to free users. For premium users, all the markets are available, and with that, we open up nearly 22 different filters. So earlier, I've only taught you 3-4 filters. There's 9 filters available for free, but there's over 22 filters available for you on REIT Screener Premium, and it's just $99 a year. And if you want an educational component, it's additional $69, and you have over 500 minutes of REIT education. If you found me interesting here, just imagine what will be on my recorded 8.5-hour course. You will learn so much more about REITs, and we do case studies both in Singapore and overseas as well. And it's only $69, and you get that for a complete lifetime. $99 a year to keep your REIT Screener Premium subscription. And for those of you who want the data boost, so data boost is actually the historical data. So you'll notice that I've been clicking on the REITs, and every time I click on the REIT, I show you the historical data. So for example, when I click on this, I get the price to book ratio historical chart. Or if I click on this, I can see the distributions of trends paid. Or if I click on this, is the weighted average debt maturity or the interest cover. So this historical chart, so you still get these numbers, you still get these trends, but these historical charts are available for data boost. So the data boost people, yep, that's $248 a year, and you also get the education component completely for free. You get the historical financials and the valuation matrices all there. And today, because you are joining me, I'm just going to show you how you can get this completely for free. And that's what I want to offer you. So thanks for joining me, staying to the end. And I hope you already got so much bonus, but let me tell you how you can get this completely for free. And all you have to do is to sign up for Singapore's most comprehensive and value for money REITs workshop. And you can sign up at otcsreits.eventbrite.com, and it's only $688. But for those of you who are Singaporeans aged 25 and above, we are SkillsFuture approved, which means that if you sign up, you actually can get a top up in October. So the cost is completely free for you. Or for those of you who are using your existing 500 that you have not even used, you can offset that 500 and you only pay 188. Just imagine, 188 is actually cheaper than $168 US dollars. So $188 in Singapore dollars is actually, and you get that completely for free, because we'll bundle this together with the course, and it's only 188. And I teach you a trick. Because the Singapore government is going to top up the SkillsFuture for another 500, which means that if you do the SkillsFuture claim in October, you sign up today, pay 188, then do the SkillsFuture claim in October, you claim all $688, and then because you overpaid, we have to refund you $188, and wow, it's completely for free. And that's the trick, and how you can get REIT Screener for free, how you can get my comprehensive course for free, because Singapore government is just paying for it. Of course, if you're PR, you can't do this, or if you're a foreigner, you can't do this. The Skills Future is only for Singaporeans aged 25 and above. So if you want to sign up, head to otcsreits.eventbrite.com or scan the QR code that's already on your screen right now. It'll bring you to the same link. There's actually 2 dates that you can choose from, middle of October and middle of November. So middle of October is just before the REITs releases results, and we will, and if you believe what you have learned today is of value, there's so much more to learn during this session. You know, for a full day, we'll be covering understanding REITs. We'll talk about business trust. We'll talk about REIT regulations around the world as well, so you can understand the difference between the Singapore regulations against the Australian regulations, against the Hong Kong regulation, against the US regulation. And then you can see how to exploit those opportunities and why some of those REITs overseas actually gain so much more than Singapore. How does a REIT grow? How does it finance itself? How do you look at forward indicators to know before even the REIT releases result, it's going to release good results? How do you know that? Because we don't look at history, we also teach how to look at forward indicators. So before REIT releases results, and you can see that if you join me in my October course, before the REIT releases results, you know, in the second half of October and the first half of November, see for yourself, test out this method for yourself. I'm going to share with you things that are forward-looking, not backward-looking. So today we looked at a lot of backward-looking stuff, but how do you know tomorrow the REIT will still increase their DPU? How do you know tomorrow the valuation of the REIT will still increase? And this is because I've been looking at the forward-looking factors, and I know that the REIT is poised to recover in 2020, so I'm positioning my portfolio for that. Characteristics of different real estate sectors. We talked about a bit of COVID today. How to read the financial statements, how to evaluate them, how do you value them, how do you put a price and value, how do you know whether it's really overvalued or undervalued. And I don't teach simple above 1, below 1 price to book ratio. I'll show you the right techniques and how to get the right price. How do you assess risk? Every investment has risk. So how do you look at your risk, size your portfolio correctly? And finally, how do you know whether the REIT manager is working for you or working against you? How do you assess the quality of the manager? We'll cover that as well. And finally, we'll teach you how to structure a portfolio of REITs. And that's only day 1, you know. So today we talked a lot about consecutive DPU growth, consecutive NAV, conservative interest cover. But there's so much more to learn because we've talked a lot about the past and present, but the future is very important. How do you know the macroeconomics is going to support the REIT as a multi-cycle? So how do I know data centers are multi-cycle? How do I know the macroeconomics is supporting data centers for a multi-year cycle? How do you know the next REIT is poised to grow? How do you know the macroeconomics is going to change for the REIT? How do you know the REIT can continue to grow its DPU organically, inorganically? What are the risk factors you need to look up for in the future? Not in the past, in the future as well. How about management track record? How are they aligned with your interests, not against your interests? And finally, how do you avoid REITs with all sorts of financial engineering? And I'll show you so many examples of REITs with financial engineering and how they are not sustainable. So make sure your dividend is sustainable. And with that, on the second day, we'll be doing case studies. So besides just using Singapore example, we'll also be using case studies from US. So we have at least 2 US, Australia REITs, Hong Kong REITs. We'll do in-depth case studies. We'll show you how to apply everything you've learned. And by the time you finish, you will have 5 ready to invest REITs right in your hands. Whether you buy it or not, it's up to you. But there's something for everyone because they follow a different format, different structure. They have different themes, different thematic plays, but they're all forward-looking. And I believe that if you hold on, you can get 20% capital gains easily on top of the dividends you're going to receive. Again, I will have to stop at pros, cons, risk, rewards, management. I can't tell you to buy or not. So finally, you have to decide whether you buy it for yourself. So we can only do up to that level. So I cannot help you to click the button because I'm not licensed to provide that financial advice. But I think giving you that baseline to see how I think about REITs across the world as well, I think is definitely something very favorable. And of course, I've said you get the recorded version of the webinar for free. So this stays throughout. You can 8.5 hours. You can revise many times as you want. They're all in bite-sized chapters. You get 1 year complimentary access to REIT Screener, and renewal is just $99 a year. And other services, for example, the data boost if you want it, and all that, we'll look at over 50% discount on some of our additional services, up to 50% discount. Of course, on top of that, you have direct support to me. You will have my WhatsApp number. You can contact me. You can write to me. I'll give you some of the Excel sheets that I've used to analyze REITs so that you can also follow and analyze other REITs, give you sample reports, sample research reports. I'm contactable over WhatsApp anytime. I'll try to reply you as best. And I usually reply quite detailed. So for those of you who have written emails to me before, you will know my replies are actually fairly detailed, although I do sometimes make you do some homework. But yeah, these are some proven success stories. So Mr. Tan here has made back over 100 times my cost fee. So he's made $60,000 from the $688 he paid. Miss Kwok here made over 10 times the cost fee. So she's made over $6,000 just from these case studies that I've given. Mr. Chua here didn't tell me how many times he made, but he told me that the cost, he loaded up on some of the case studies and he's already covered his workshop fees. And this is matter of months, because this is how fast some of the REITs they grow. See, this is the only course that teaches you about getting capital gains through overseas REITs instead of the usual dividend. The content was case studies was superb and the course was free. This Mr. Tan said, very worth it. And I already made, and these few years shot out, I also bought this, made more than 100 times your cost fee in 5 months. You can use this for marketing, but don't mention my name. Okay, sure, Mr. Tan, I've hidden your name, so I'm not mentioning you. Of course, Mr. Neil here, said it was absolutely worth the money. Here, thanks for the tip. He bought some. Next day, he just made 5%, and now he's roughly 15% in the profit, excluding the dividends he's already done. Mr. Po here thanks me for even replying so detailed on a Chinese New Year day. So I think these are really some unsolicited requests that people have just given me. You get a copy of my bestseller book, REITs to Riches, as well. So on the course itself, I'll give you a copy of the book. So this is the bestseller book that actually got me started in this. I never planned to be a workshop seminar teacher, but this was the book that really launched me into this situation. So yeah, you'll get a copy of my best-selling book as well. And to reiterate, what you get is the 2-day immersive program to REITs to Riches workshop. You can pick the October date or the November date. These are the few runs we have for Q4. We are fully compliant. We are actually, because we're Skills Future approved, we are regulated by the Ministry of Education. So we have to adhere to the social distancing measures, temperature taking, and safe entry taking as well. So make sure that we will make sure you're safe. You get 1 year complimentary access to our $99 REIT Screener Premium for free. You get over 500 minutes of recorded revision, and this is completely for free for you. You get sample reports, sample analysis, Excel sheets that you can use as well. You can contact me anytime. I'll try my best to give you a very complete answer, and I usually do so. And a lot of people, sometimes they reply me, and then they'll ask further questions on that, and I reply as well. So there's really ongoing support, and I'm always there to reply emails. So on top of that, you get a complimentary copy of my book, and the best part is price is locked in. You can reschedule anytime you want, and we are actually, because we're regulated under Skills Future, we're regulated under Ministry of Education, we can't just raise our prices anytime we like. When we raise our prices, we need to request permission from the ministry to actually raise prices. Just like the public transport in Singapore, they actually have to request permission to raise prices. We have requested our permission. They have been in touch with us. They understand our situation. They know how expensive courses are out there. And most courses that you take will easily be 4 digits, 5 digits, some even 5 digits, 4 digits, multi-thousands. But they know that we're actually undervalued, underpriced. A Skills Filter representative has set into my course, and they have assessed it. They know the quality, and they are likely going to give us permission to increase prices next month. So here's your last opportunity to get in at 688. So even if you are a foreigner or you don't have the Skills Future to get it for free or pay 188, just make sure you lock in at 688 before it moves up next month. And we are the highest rated Skills Future course on the Skills Future website. So you can see we are rated 4.9 over 5, 5-star, and over 500 people have received our training, and over 500 people received our training. 126 bothered to actually reply a survey from the Singapore government to tell them how much they enjoyed the course. So we are really one of the highest skills future rated course at 4.9 over 5. That's how our customers rated us. So I think there's no better deal than this. I think for a 2-day comprehensive workshop, 688 is really a very good value price. And with our skills future backing and backing from the government, you can actually get this for almost free. So we'll show you how to get it for free. Just to book, head to otcsreits.eventbrite.com, or you can scan the QR code that's right on your screen right now. So I'll leave it here and I'll pass the time back to Richard, who is the moderator. So I will actually silence myself for a while, since I think Richard has something to share, right?
Yes, hi. Okay, thank you so much, Wien, for the very comprehensive insights into how we can write the COVID recovery for REITs. And right now, if you have questions, and thanks for those of you who are with us till the end, and if you have questions, please type it into the chat box right now, and I will be posting them to Wien to reply to them. And for those of you who are watching on YouTube, you can't ask questions there, so please come inside the webinar room to ask your questions. Okay, so just want to highlight a few things. I think firstly is that I have sat through Wien's course myself, and I really think that it has a great value. It's 2 full days, lunch included, and for this price, it is really, really undervalued. So if you like to get things that are undervalued, I think this course would be for you. And second thing is that I think as an improvement, they have included the 1-year access to the REIT Screener Premium. So if you believe that you want to look and monitor REITs in the next 12 months for entry, because some of them have dropped, and some of them maybe even dropping further, becoming more undervalued. Maybe after the US election, things might move as well. So if you want to have that kind of monitoring, this will be a good time to go for the course, learn how to do it, and then use the tool that Wien has created to help you to do that, to monitor. Okay, so let me see. And so while waiting for the questions to come in, so please go ahead and type it in. Don't be shy. If you have questions, today is a good day to ask. All right. So again, I'll flash on the screen. The 2 dates that Wien has prepared for the in-person REITs course in Singapore would be on the 17th and 18th of October and 21st and 22nd of November. And if you pay through this link, you will lock in the price at 688. And if you can't make it on those dates, you can reschedule indefinitely, because as you have heard from Wien, they have applied for the price to be increased. And if they get it, the price will not be at this 6A anymore. So if you know that REITs is something that you have been looking at and you want to get in and you want to have a good framework and a tool to help you, then please take advantage of this offer that Wien have for you. Okay, so especially for those of you who are Singaporeans who have unused skills futures, I think it's a no-brainer. All right. So while waiting, if you have any questions, please feel free to post into the chat box, and don't be shy. And while waiting for the questions to come in, Wien,
yes,
in the tool, just now you show the 1 standard deviation, 2 standard deviation. Now that is quite an unusual way of looking at things, that because most REITs investors will be looking at a price chart. Now, for the benefit of those people who are looking at that chart for the first time, maybe you can just take over the screen again and just show price over NAV historical chart, and then maybe just explain a little bit on what is that chart about. Is it price or is it not price?
And so
now we look at Kappa DC REIT. I also have.
So you also have. So remember this is the net asset value, and the net asset value is used to calculate the price to book ratio. And why do I always say don't use above 1, below 1? Because there's so much intangibles that market. has priced in as well. So if you do that, what happens is you end up picking REITs that are usually subpar, and I showed you that before. And let's just do something simple, right? Again, let's just look back at how I would have traded. So again, put in the three things. Make sure you are not in the negative growth. So I don't want negative growing DPU. I want moderate risk or even very safe risk. It's up to you. Look at the kind of data that comes through. So then after that, I would use the price to book ratio. So the price to book ratio, notice that in REIT Screener, we don't use the term above 1, below 1, put a specific number, because every REIT is different. Every REIT has a different average. So how can you just put a fixed number to filter across REITs that are so vastly different? How do you put a price to book ratio for different healthcare industrial sectors where they trade at completely different valuations? You can't. And that's why a REIT Screener is so unique, that we actually use the price to book ratio and actually adjust it per REIT. Every single REIT, we calculate where is the reasonable zone, the good value zone, bargain zone, the expensive zone, the overpriced zone as well. So you can see right now, within the reasonable REITs that has been growing for the last 2 years, in the last 7 years, Mapletree Commercial and Mapletree Fraser Centrepoint Trust is one of those. Expensive REITs, for example, Ascendas is a bit on the expensive side, but not overpriced. But the overpriced REITs are the Mapletree Industrial, Logistics, Parkway Life REIT. If you own one of these three REITs and you have made money, congratulations, it's one of the top 5 performing REITs. So if you are holding this, congratulations. So yeah, but will I buy it at the current price? No, I think I'll wait for the price to retrace down. So prices go up, prices do go down as well. So I think Richard had a request for specifically Capital DC REIT, right? So let's take a look at that. Capital DC REIT, let's just do a quick check. What are the 3 things I told you to check? First of all, growing dividend, and you can see the dividend is definitely going up. Growing NAV, is the NAV going up? Also, again, you can see the NAV is showing that same trend. Looking at the interest cover, wow, 12 times. That's way over my 5 times. And you can see Capital DC REIT doesn't show up in the 7 years because it's a relatively young REIT. It's only 4 years old. So it shows up here. You can see compounded, it grows about 6% and 6.5% on their DPU as well as their NAV. Compounded per year, this is compounded per year for the last 3 years. That's what it means. And you can see this REIT's been doing very well. It's actually increased from about $1 in 2015 to about $3. It's broke even $3 something at one point, right? For those of you who are interested in technical analysis, you can click and actually get the technical analysis chart. All the tools for technical analysis are all here as well. So that's all that provided for you, and all your indicators as well. So again, Richard was asking about the price to book ratio. So you can see right now, it tells you the 52-week low PB, 52-week high PB, and we put an arrow where it is. Gives you the 52-week low dividend, 52-week high dividend, and this gives you the yield spread chart, and this gives you the price to book value chart. So again, on average, what this line means is, you can see where my arrow is. On average, I'm pointing at the orange line, and where the orange line is, on average, tells you that Capital DC REIT trades at 1.5 times its book value on average over the last 4 years, since 2015. So if you had bought it in 2015, congratulations, you have actually bought it below price to book ratio, below its average. If you are right now here, I would consider taking half my profits first and let it retrace a little bit down. I would like it to come out. See, during the COVID-19, you see it retraced to actually fairly good value region, even though it's 1.5 times book value. So if you are trading using the traditional mindset of looking for it to drop below 1, in Singaporean terms, we say wait long, because it's not going unlikely to trade at that valuation, because it has so much intangibles into it. There's so much optimism about it. It's growing so quickly. People are looking at forward growth. And dropping to the orange line gives it a really good value already. You're already at its average price to book ratio. So why not start to nibble here already and then ride the growth again? So you can see Keppel DC REITs skewed a lot tremendously. Although right now, I wouldn't chase it at this current price. But if you had bought it at this price, congratulations. I think the low during the COVID was about $2 or $1.90. You know, if you had bought it and kept it for multi-years, I mean, I've kept my positions here. I sold my positions before COVID somewhere here when it broke. Fortunately, I managed to get back a little bit, but I didn't add back my full positions. But yeah, retrospectively, you know, I should have bought so much more during COVID. But again, we look forward, right? So that's a bit of Keppel DC REIT.
I just think that this chart is helpful for people who wonder when are things undervalued and when are things overvalued.
So it gives you opportunities to buy and opportunities to sell, right?
Correct. Yeah. So if you don't know any other ways to enter and exit, then this chart might be helpful, and Wien will go into greater detail how to use it in his 2-day course. Yeah, correct?
Yep, for sure.
Okay.
And much more. So here's the chart for Fraser Centrepoint Trust, which I think is one of the REITs that will poise to recover very quickly. I also mentioned Mapletree Commercial Trust. So I'll just put up the chart there for you to see where we are right now. And they're hovering at reasonable values. They're not very cheap, but they're not very expensive as well. You know, they're hovering at reasonable values. Of course, if it comes down to this price, of course, then it's good value. But who knows where the stock market is going to go? I think opportunities may come very shortly. I hope, I mean, I've been slowly easing into the stock market throughout September and October. I think it will give some buying opportunities. I don't know, perhaps the stock market, some people say the stock market may crash if Trump loses his election, but I don't know. I don't even know how to predict whether Trump's going to win or not. So, well, I can't stop investing, but yet at the same time, I will remain cautious in my portfolio.
Right. Okay. Thanks, Wien. Thanks for showcasing the tool, price to book historical chart. Okay. So now I will take back the screen for a while.
Oh, sure. Go ahead.
The questions. Okay. All right.
So what happens when you take the screen? You still see my video or what?
No, I still see your video is still on.
Okay, right, got it.
So don't dig your nose. Yeah.
All right. Okay,
I think what you have shared is very comprehensive, and the questions are a bit more on clarifying on some of the questions you asked. But I think they are really very simple. So one of the question is Pokey is asking he's keen on taking the course, but Sundays is off for him. So he's asking whether there's an online version that he have access to or not.
Yes, actually, we do have the recorded version. Remember, we give you the 8 hours recorded version. The recorded version is not fully complete, but we have people who have joined us Saturday on one day, and then after that join us on another Saturday on another course. Of course, by then the what do you call that? The case studies may change because I change my case studies seasonally. So if you ask me what are the case studies ahead of time, I may not even know. I'm actually starting to look for opportunities and then writing the case studies for October class right now, actually. So it's almost about 2+ weeks more, 3 more weeks. And then so I'm looking at the conditions of the market, what REITs give good value, and then that's the REITs that I will probably put in. And then November, I'll have to look again. Maybe after the elections, there'll be some other interesting buys. I may change my case studies. So yeah, so case studies will keep on changing. So if Sundays are completely off, so what I'll advise you is come on Saturday and just speak to me. Tell me your problems. Let's see how I can address your problems. Yeah, and I mean, there are people who actually want to sign up for my course. They ask me, can you stream it? You know, because I'm stuck in, so there was this guy stuck in Europe. He's actually a PR and he can't come back to Singapore now. So he's stuck in Europe and he's asking me, how do I take your course? And we'll adjust special things, or maybe we will have a special one-on-one session with you just to tell you the important things. I obviously cannot spend one full day with you, but maybe we can group these people who have these problems with Sunday, and then maybe I spend an hour or two and you go through some case studies so to emphasize things. So there are ways to work around. So we'll just tell me your needs. We'll see how we can address them.
Right, great. So CJ is asking if he or she wants to access the free REIT screener first. Is it okay? So
yeah, of course.
it's
completely free to use. Just head to www.reitscreener.com and you can sign up here. So of course, I'm already signed in, but you should be able to sign up. You just need to sign up with your name, email address. We don't use password, so you don't have to set a password. Once you sign up, a magic link will be sent to your email. And once that magic link is sent to your email, you just have to click that magic link and then it will lock you into REIT Screener. That's it.
Wonderful. So Hadley is asking, does REIT Screener filter sectors? Just now you showed countries, but is there a filter called
sector? Remember, I told you I don't like hospitality. I remove hospitality sector.
Okay, so the reply to that question will be a yes.
Right. Yes, for sure. So we cover sectors. In fact, if you want to see what are the filters we cover country, sector, market cap. We cover volatility as well. We actually know the volatility, and we'll cover wild volatility, volatile, normal, low volatility, normal volatility, stuff like that. So if some of you are what we call low beta investors, so and there's a strategy for that as well called low beta. So you can actually predefine the strategy. So based on the strategies, you can actually tune it. For example, are you a yield chaser? Are you a value growth investor? And we'll tune the screener just straight for you based on what you are. But if you want to look through the screener, dividend yield, of course, property yield, these are the cap rates of the property, occupancy rates as well. So you can see some of these are so REIT specific, so real estate specific. You won't find them on any other screeners. So how do you find a screener that has property yield or occupancy rate? How about rental growth, rental reversions? How about whale? Can you filter on whale? How many screeners do you know have whale? Income support, yes or no? Dividend growth, of course, you've seen that. NAV growth, you've seen that. How about borrowings, including and excluding perpetual securities? How many screeners can differentiate perpetual securities? Not very many.
Screen, you're not sharing your screen at the moment.
Oh my gosh, I see.
Go ahead and share your screen as you just run.
Oh, right.
Yeah. So while I post to you some other questions. Now
okay. So let me share my screen. Oh, sorry. Thanks, Richard. So I wanted to share with you again. So again, you can see. Okay. I'll just reset again. So you can see, yes, we can filter on sectors. You can see all the various sectors, and you can see I can take out hospitality sector, for example, and I can filter based on without hospitality sector, without other sectors as well. So the sectors are all there. And I just wanted to show you the different screening methods. So you can screen on size, volatility, dividends, price to book ratio, occupancy rates, rental growth, property yields, whale, income support. You can filter on including, excluding perpetual securities, interest rates, duration. So there's so many filters you can filter on. And when you look at a particular REIT, for example, Keppel Pacific Oak, you can see that it's so detailed. We have the price chart. We have all these key statistics for you. We tell you the 3-year, 5-year, 7-year growth. We give you the financials. Of course, Keppel Pacific Oak is a relatively young REIT, so the data doesn't show up in the 3 years. But you can see the data would show up here in, for example, Fraser Center Park, called Keppel DC, Richard's favorite REIT. So you can see we even show you the historical occupancy rate. So you can see what's the occupancy rates in different years, whether occupancy rate is trending up, trending down, flat. What is the growth rates? What is the weighted average lease expiry? So we even track those historical data. And this part of data boost as well. You can look at revenues. You can look at the free cash flow. For American REITs, you can look at the FFO and AFFO. So you'll see that in most of the other American REITs as well. So you can see that, like Equinix, you can see the FFO and AFFO data as well. So this very, very REITs tuned. What is the interest cover? What's the interest rates that the REIT is paying? And the truth is, there's no other screener that's tailored specifically for REITs. There's a lot of stock screeners out there, and some of the stock screeners are free, some are paid, but none of them are tailored specific for REITs. And if you try to use like price to earnings ratio and you start to use that, it's funny. You just don't get the same results as a purely well-tuned REIT screener. So hopefully that answers your question.
Okay, Wien, next question. They are asking about location and size of the venue, size of the how many students in the class?
Okay, my past classes were about 30, but because of the social distancing measures, we can only do 20 now. Of course, my last class was a lot smaller, was like 10, because I think we just got the approval to run the class, so some people were uncomfortable, but I think it's building up, so it's slowly about 10 to 15 people. Social distancing is necessary because that's the requirement by Ministry of Education. So the venue is actually at the Singapore Shopping Centre. So again, if you head on to otcs.eventbrite.com, you should be able to get to our registration page. Oh dear, how come I did not get into the registration page? Did I miss something? Did I spell something wrong? otcsreits.com. Did I spell it wrongly? otcsreits.com, .eventbrite.com, and you should get into our registration page. You can see the REITs to Riches OTCS. You can select the date, and you can choose between the October date or the November date. And for those of you who are taking Skills Future, make sure you pick the Skills Future one, which is $188 rather than the 688 one. 688 is for foreigners. The location is at the Singapore Shopping Centre, room level 2, and that nearest MRT is Dhoby Ghaut, and the address is right here. You can read all about the event when you scan the QR code, and we talk about the practical hands-on case study sessions, all that, all the requirements we have to do during the COVID situation, including taking your temperature. You have to do a contact declaration, which is the safe entry, and we will take your temperature, and if you are above 37.6, we will politely ask you to please don't join the class. We will make it up for you at no extra charge if this is your situation. So
okay, let's go to the question. Yeah, okay. So another question is for people who have already used some of the Skill Futures, then which option should they choose when they try to sign up?
Pick the 188 option, because then we will just follow up with you on the difference. Now, the trick is this. If you have already used, I'll just give you a hypothetical example. The cost price cannot be negotiated. Now we are regulated under the Ministry of Education. So it's fixed at 688, is fixed at 688. We cannot change prices. We cannot move it up, neither can we move it down until we tell the ministry. So we can't just give a discount. But what happens is if you have $300, so $300 goes to offset, then you only pay $388. But the trick is this: October 1st, the government is topping up another $500. So even if you have used completely the $500, the trick is this: pay the $188, and you will get an instruction how to claim your Skills Future. Wait until 1st of October to do the claim. That's the trick. And for those of you who haven't used your $500, you're going to top up $500, then use it to claim a full $688. That's the trick. And then you can completely get the course for free, get REIT Screener for free. There's no loss to you. My gosh.
Okay. So that answers a question of quite a few people who are asking about what happens when they have used the Skill Futures. And the key
so
thing
the top-up is coming, unless you have used your top-up as well for the special COVID. There are certain courses that are approved to be taken with Skills Future during the COVID season with the top-up. So unless you have used it completely, then I'm sorry, it's still 688 for you. But yeah, hopefully but most people, I don't think, have even used their original 500 Skills Future, which means including the top-up, you would have 1,000.
Right. So to answer the attendees who have that question, that means you simply go and choose the 188 option, pay the 188, and then wait until there'll be an instruction that will be sent to you to perform the claim, but don't do it yet. Right? Don't do it yet.
Do it after 1st of October.
Wait until after the additional 500 is top up into the account, then you perform the claim. Then because when you claim, there'll be an overpayment because you pay an extra 188, right?
Yeah.
For those
so
who have not used.
After the overpayment is detected on our side, and after you sign the attendance, after the course, you finish the attendance, we will refund it to you, the 188 back to your bank account. We will ask for your bank account details, we refund it back. Because you overpaid, so we have to give it back. Under Ministry of Education, we cannot charge you more, we cannot charge you less. I'm serious, so we have to refund you.
Right.
If not, you can file a complaint with SkillsFuture, and the SkillsFuture will strike us off the SkillsFuture list.
Okay, good.
Yeah.
So another
And we wouldn't want that.
yeah. Another attendee is asking whether a laptop is needed.
Yes, please bring your laptop, because when we do the case studies, you'll be searching the internet for things, and I'll share with you a lot of interesting insights. How do you look at things? A laptop is just so much easier. You can actually use a phone, but I find this phone so small. I recommend bringing a laptop, especially on day 2 on the case studies. Day 1 still optional, but I think it's better if you bring.
Okay, Wien.
All these are actually sent as instructions. When you sign up, you'll get all these instructions as well.
Good. So we have questions coming from overseas attendees, because I think our webinar also reaches overseas friends. So they are, so what can they do? I mean,
all right. I don't know if you're Singaporean or not, but this answer, if you're not Singaporean, it is 688 Singapore dollars. So now I understand that some people are overseas. They have actually asked whether they can get a copy of the recording. Because we don't record the live courses, but I actually have an 8-hour course that I've recorded that I can that you can actually sign up for. So maybe an alternative is to sign up for the recorded course. So that one would probably be this one. So you sign up for the recorded course, which is 168, or if you want it with the data boost, $248 US. So you can sign up for that as well. If you're overseas, that's one option. Another person has asked whether he can actually sign up, lock in the price, and then when he comes back from overseas, can he attend the course? Yeah, because we offer you a unlimited reschedule. So we lock in your price and we promise an unlimited reschedule. So there are some people who want to lock in their prices now. That's also possible. So if you're interested, I would say, why don't you head to get this bundle instead? So this bundle instead, and have the recorded course online, and I'll support you through email. The other alternative is we'll probably have to plan for group sessions for those people who are overseas, and then we'll have to cover specially for you online. Yeah, just write to us and let us know your troubles. We'll see how we can best address it. So maybe this 168 or this 248 is the best deal for you then instead.
Okay, thank you, Wien. Maybe before we end out the session, because of time, we have overrun already. So can you go to your very first slide where you have your contact information so that they can email you if they have any more questions?
Sure. So my contact information, you can email me at wien@probutterfly.com or wien@readscreener.com, or you can visit my blog. My contact information is on the blog as well. Contact information, not so much on REITscreener, yeah, but that's my email. So feel free, I will reply. I'll try to reply as much as possible tonight or tomorrow. So I'll see what we can tailor the best for you if you don't fit into the group where you are actually physically in Singapore right now. We are considering to apply, but because to convert the course to online course. So right now, our approval from the ministry is to conduct the course under the ministry's guidelines on offline, not online. So until we get the approval to do it online, if not, if I can just conduct a course online, but then it won't be claimable for SkillsFuture. So we still have to adhere to the ministry's requirements. So we're actually quite a regulated entity. Yes. Actually, I'm a very regulated course.
Yep, and a very highly rated one as well. So well done, Wien. Yep. Okay. So with that, I think we have covered all the important questions grouped.
But I think they can still write to me. I think I was having a webinar some time ago, and I had like so many questions coming through email after that. So I spent the next 3 days just answering all your emails. So don't worry, just ask your email. I know some of you may. I know another popular question is probably first REIT. What do you think of first REIT? I'm sure a lot of people are asking that question. And but just write to us. And I'll answer you over email.
Wonderful. So here's Wien's contact information on the screen. So for those of you who ask whether this session is recorded, yes, it is recorded. And then if you have registered, we'll be emailing you the link, and then you can watch it on YouTube after the session. Okay. So with that, we have we have overrun by about 8 minutes, so it's still good, still good. Yeah, so Wien, thanks a lot for your sharing and very detailed and comprehensive insights as to what we can do to ride the COVID-19 recovery. And for all of you who have hang on with us until the end, I hope the session has been beneficial to you. And please don't forget to join our Telegram channel to be kept posted of future events. And with that, Wien, any last words before we sign off?
No, I'm just flashing on my screen again the link OTCS REITs.eventbrite.com. So hit that or scan the QR code. You can even message me directly through Eventbrite. So Eventbrite will then forward me a message, which I'll reply you as well. So some people contact me directly from Eventbrite if you don't send me an email. So there's so many ways to contact me. Yeah, quite a public figure. So again, this is Singapore's most comprehensive and value for money REITs investment workshop. It's the only REITs investment workshop in Singapore that is 2 full days. Most are 1 day, some half a day, and this is 2 full days, and it's almost the same price. And we are actually Skills Future approved. We are under the Ministry of Education, which means you can actually use your Skills Future credits. So our syllabus, we cannot deviate from what we have submitted and what we have approved by the ministry. So rest assured, they have reviewed us over 6 months before getting our approval. It took us 6 months back and forth with the government before we got our approval. So you can assure that it was a very thorough process, and you are really getting a highly, highly good educational product here. So yeah, that's all I really want to share. The QR code's on screen, and I don't know where else can you get to learn about investment paid by the government. Please tell me another country where you ever get this benefit.
Yes, absolutely. Okay, thanks a lot, Wien. Thanks for your time, and thanks everyone for attending, and I'll see you at the next OTCS workshop. Okay, good night, everyone.
All right, good night. See ya.
Bye.
Bye.